Go, we're going to see maybe a fairly muted start to the day. So the FTSE 100 up by 0.1%. The Stock 600 comes through any second now. There you go, up by 0.1%. At an index level, we're not seeing a lot of activity coming through. There's some big macro themes that we need to factor into our thinking. What is happening in the Middle East, what's happening with the strike story in the United States, how does that fold into the central bank story? But the bottom-up story this morning, I think there's a few things that are really worth digging into. The CAC 40 in particular, starting soft this morning. What's going on below the surface, Critty?
Well, it is the French stocks that are dragging the Stock 600 down lower. Your biggest from an index weighting perspective is going to be LVMH right out of the gates, as is Total and carrying as well. It looks like luxury really on the back foot here. Your outperformance, though, coming from a lot of your big tech names. The idea of Novo Nordisk, ASML, SAP, those are your outperformers alongside some of the biotech names. Perhaps that's where you're seeing some of the green on screen in the FTSE.
Yeah, so consumer products and services, the worst performing sector. As you say, Chrissy, there's a lot of luxury in the mix there. Utilities and energy also not doing so well. Energy was the only sector yesterday that actually gained in Europe. So we're seeing a bit of a reversal of that. And oil prices are a little weaker despite the tensions in the Middle East. 71.51 is where we trade on Brent. So that's the downside. Yes, to your point, Critty, then technology not doing too badly in terms of the early performance. And food, beverage and tobacco also on the rise. I also saw media was strong out of the gates, but doesn't seem to be lasting particularly.
No, I'm struggling to find a kind of clear line that runs through some of these stock stories. The Fortum's a little bit softer, so the luxury names are down as well. So the energy names are certainly soft. In terms of the points, it is LVMH, L'Oreal that are really doing the damage on the downside. That's where the French market story is coming through. But we've had a really good run on the back of the China story. I just wonder whether everybody's looking at that and going, that was nice. Yeah. I'll take a few chips off the table.
It's a fascinating one. A lot of it's going to be positioning as well, coming from yesterday as well. Look, this is all going on in the micro front. Let's go back to the macro here. Bloomberg's Francine Lacqua is in Germany at the Berlin Global Dialogue Forum. She's got an exclusive conversation, of course, talking about all things infrastructure, trade, and plenty more on the agenda. Francine.
Thank you so much, Critty. I am delighted to be joined by the one and only Larry Fink of BlackRock. Larry, thank you so much for joining us. First of all, happy anniversary. There was that prospectus of 1st of October, 1999, where BlackRock went public, so you're 25 years young.
It's great reading, wasn't it? Yeah, I mean, it's a really good day for us. It's our 25th anniversary. It's our day that we are closing GIP, and right around this time, we're going to have our 30th anniversary here in Germany. So it's a good day. I'm very pleased that our stock performance is up, close to 11,000% over that time. Actually, 20 times greater than the S&P. So
the market has changed so much in that time. I mean, it's amazing. In 25 years, there's a lot more private. There's a lot more credits. You're gone into infrastructure. I'm not going to ask you what the 25 years to come will bring, but what are you most optimistic about in the next 3 years?
Well, I think one of the reasons why our stock has done so well is I think we understood that more and more of the global economy will be moving to the capital markets. And I think all those things you suggested is just an indication of all the movements towards the capital markets. And I think this is going to be broadly a world event. We're seeing more and more countries focusing on their capital markets. A great economy is an economy that has a strong capital markets and a strong banking system. We've seen here in Europe, historically, a strong banking system and a weak capital markets. That's changing right now here in Europe. But in other countries like Japan, you had the Kishida government doubling down their retirement tax deductibility for a product. They have a desire to building out their capital markets. In India, Prime Minister Modi is focusing on retirement to build out their capital markets, to broaden their entire economy. And I think that's the movement for the next 25 years in front of us, a further broadening of the global capital markets, whether that is private debt, infrastructure debt, private equity, venture capital. And I think this is important. And if I look back over the 25 years, one of the strengths that I see is because of the strengths of the U.S. capital markets, the U.S. Influence in the world has become broader and greater than it was 25 years ago, and that is because of the depth of the capital markets.
But in all of this, Larry, where do you find the best deal? So, for example, in infrastructure, if you look at the closure of GIP, it's today. This was a massive play. What does it mean for integration? What does it mean for actually fundraising for infrastructure?
Well, GIP is in the midst of closing a $25 billion infrastructure product. The old BlackRock, our infra team is going to be raising another $10 billion. And then we announced a partnership with Microsoft, NVIDIA, and MGX. We have aspirations of raising $30 billion of equity, and then beyond that, more debt associated when we build out these AI data centers. So to me, this is the dawning of infrastructure. When I look around the world today, I see the inadequacies of infrastructure in almost every country. So we need to be decarbonizing, we need to be digitizing, we need to be moving forward, we need to be building out more and more. And I think this is one of the big issues. As I wrote in an editorial a few months back in the FT and I spoke at the G7, I spoke about every economy needs to focus on growth. There's too much focus on, should we lower taxes, should we raise taxes? Not enough. How do we stimulate growth? And I think infrastructure is a major component of how we stimulate growth. And we don't, because of the breadth of the capital market, we don't have to rely on federal spending or state spending. There is enough capital in the private sector that will be able to fund these new projects. And so to me, this is a dawning of the new reality that we're going to see broadening of public and private investing for infrastructure.
Is there a worry that it becomes quite political? So there are a couple of projects, Malaysia, Minnesota, that have been politicized. Is there a danger that infrastructure becomes a new ESG?
I see a very different outcome of that. This is helping government build out their infrastructure. There is no question, there may be one project or another project that may be politicized for one reason or another. But overall, in my conversations with politicians worldwide, they know they're in need of more private capital. So I dearly hope it's not politicized. If it's politicized in one location, it means money is going to seek another safer spot. And so you always have those type of risks, but capital is free moving, and capital is going to be seeking a safe, sound investment. You know, we are the largest retirement manager in the world. Our job is to try to be finding investments on behalf of our retirees to find safe outcomes over a long period of time. So if there is an event that politicizes it, money will leave and money will seek another destination.
Where does the smart money stay away from? Is there anywhere in the markets where either something is priced to perfection or it's too risky? I know we talk about commercial real estate.
You know, markets move up and down. You always see, you mentioned like commercial real estate, you see too much money moving in one area, then it runs away from it. I think that's what markets do. We test the outer boundaries of pricing, and it becomes maybe a level in which that we don't find it's a great outcome for long-term investing, and then money moves to another destination. I think that's a natural movement, so I'm not worried about one area versus another area. The one other thing that I think everybody asks me is, you know, is the market so pricey and yet all this geopolitical issues? I would argue today, because of the expansion of the global capital markets, we're diffusing more risk than ever. There is actually less systemic risk today than ever before. You mentioned private credit. Private credit is chiefly matching a liability and an asset together. It's not leveraging 8-to-1 like in a banking system. That's a good example of diffusing some systemic risk. But as more and more capital's broadening out how they invest, where they invest, that actually reduces less concentration in one area. Of course, we've seen, especially in cities, a decline in commercial real estate. But that's a natural process.
There's
But there's nothing systemic about it. You may lose money on one building, but you're moving into other destinations like data centers. You're moving into different cities that may have rising population growth. But, you can't fight demographics. So there's some cities that are shrinking. Obviously, commercial real estate in those cities are going to be declining with that declining population.
Larry, what's your play in private credit? How much bigger do you want to be? How much do you want in this space?
We have large aspirations, as we wrote about it last year, and we continue to be building out a private credit area, and there's more to come. We're very excited about our position. If you just think about the role of infrastructure debt, if you think about what we announced with MGX and Microsoft, raising $30 billion of equity, but we're going to raise $100 to $120 billion of debt associated with those data centers. So I actually believe as we move out and building out more and more infrastructure investing, you're going to see more infrastructure or private credit associated with that. And so that will also represent a great opportunity that you have a hyperscaler like a Meta, like a Microsoft, like an Amazon, you have their credit that you're going to be able to leverage it up and provide returns, stable returns over 15, 20 years, because that's what those leases will be on these data centers. And so you have a great opportunity for long-term investing.
Larry, on the U.S. economy, and we talked about U.S. exceptionalism, do you worry that actually there are two very different outcomes with the U.S. election that could bring the economy in different ways?
Both candidates have, in many cases, very similar views on making the U.S. even stronger. Both candidates, in their interpretation of how that may happen, may differ. Our job is to work with any political position. Our job is to be working with the U.S. government, like we're here in Germany. We're working with the German government. There's going to be an election here next year, too. Our job is to be working with societies and building a platform together, and so we're not trying to make any judgments.
But you deploy capital differently under President Trump than under President Harris?
On the margin, not
that much?
No, I think we over-conflate what it means. I mean, I don't think the U.S. is going to be pivoting that much depending on one outcome. We're not focusing on the day-to-day movements of markets. We're focusing on, is the U.S. an exceptional place to invest for 5 years, 10 years, 20 years? That's what we're focusing on. Yes, there may be moments where you can have a 10% or even a 15 or 20% downdraft. Does that represent a major shift, or does that represent an opportunity? And so you have to look at it that way. In most cases, over the last 30 years, anytime you had a 10 or 20% downdraft, you wanted to be there standing by and buying. And those who ran away over a 20-year horizon have lost a lot of possible return.
Are you optimistic about Europe? So you're one of the biggest shareholders in UniCredit. You're one of the biggest shareholders in Commerzbank.
Yes.
Does a combination needs, does it make a bit of impetus for Europe? Does it make sense?
I am a very large believer on a banking and a capital markets union. I think that's the strength of the United States. Europe needs to do that. I've read the Draghi report. Because we are large shareholders in both, I don't talk about any activity about one organization versus another. But technically, I look at the strength of the United States, and much of this strength is because of the strength of our capital markets and our banking system. Europe needs a stronger capital market system, and it needs a more unified banking system. And I think that's going to be urgently necessary for Europe to go to the next step.
So as a shareholder, you don't get involved? Or have you spoken to the chief executives?
I'm not going to talk about it. And two, I don't do any of the voting at BlackRock myself. That's not my responsibility. Let me just say, I speak to a lot of executives on this. I speak to a lot of politicians on these matters. And that's between me and the politicians.
What's your take on China right now?
I would have said before these Chinese actions of last week in terms of the massive fiscal and monetary policy shifts, China was going from bad to worse. I think they recognize now that their economy was, descending quite rapidly. There was a lack of confidence. And I think we're going to have to wait and see, is this enough to stabilize I would say, the failings of confidence? As I spoke to more and more executives in China, there was a fear that, we haven't found the bottom yet. Could this be the bottom for China? You know, I think systematically you're going to see more and more companies diversifying their supply chains. And you're seeing that. You're seeing India as a great destination. You're seeing Philippines and Vietnam as great destinations. Closer to the United States, Mexico has been an incredible destination for more and more manufacturing. And so that's not going to change. We are going to see a systematic change in how we manage supply chains. I think COVID taught us a lot of lessons on two large dependencies. And with all the disruptions of supply chains, everybody's waking up to, we need to have a more resilient supply chain. Because before COVID, we talked about we need the most efficient supply chain. When you have those issues, efficiencies didn't work, and we had real big disruptions. And every company is focusing on a broadening, a more diversified supply chain, so you don't have these type of disruptions. And that's going to be a downdraft for China. So that will be continuing.
Larry, you seem very bullish about, I guess, the next 2 to 3 years. But there's a lot of, there's China, there's a lot of unsettled politics, there's AI, which I know you're playing through Microsoft and data centers. Is there anything that unsettles you that the world is living through?
Look, I think every moment it's unsettling. The war in Ukraine, which we haven't talked about, is incredibly unsettling and very destabilizing for Europe. The war in the Middle East right now with Lebanon and Gaza is very unsettling. At the same time, as I said, we are broadening the capital markets. Even with these type of disruptions, we're not seeing disruption in the energy market. And we're seeing more diversification, and so the markets are able to overcome some of these. Now, if they create more supply chain disruptions, they create supply chain disruptions for energy, that changes the whole ecosystem. But right now, I don't see anything that really, to me, is going to be disrupting this tremendous momentum. The amount of trillions of dollars that are going to be necessary for infrastructure investing is going to be vital to uplift the economies worldwide. And this is why I'm still, urging more and more economies to focus on growth, focus on how to build out their infrastructure that will lift up the economy and create great jobs.
When you look at the U.S. economy, you're expecting a soft landing? Or is there a danger, actually, that we get...
I don't see any landing. The economy is going to continue to grow at 2 plus 3%. I don't even know why we use a landing. Landing last time means it goes to zero. It goes, I know we use those words. It's really fun to talk about.
But it's not going to crash.
I've been very consistent. We're not going to have a hard landing, but I don't see a soft landing. We're going to continue. We're continuing to move and navigate it. But despite all that, there are segments of the economy that are struggling. There are segments of the economy that are doing really well. We spend so much time focusing on the segments that are doing poorly, and I'm not trying to suggest that's not the right thing to do, but we're not looking at it in the holistic way that other parts of the economy are doing really, really well. Look at corporate earnings overall. They've been very strong. And I think they're going to continue to be very strong. We have, we do have segments of the economy that are very strong, and I think that's why I don't know why we talk about a hard or soft landing. We're continuing. We're going to grow at 2 to 3%.
It's the Fed watchers. Blame the Fed watchers because they're all.
Who are they? I don't follow them. By the way, let me just tell you one thing. Right? Let me just tell you, I think the forward curve is wrong. Okay. We're not going to see, and I think Chairman Powell said that yesterday. We're going to be patient as we. I think the amount of easing that's in the forward curve is crazy. I mean, I do believe there's room for easing more, but not as much as the forward curve would indicate.
And this is what, a flaw in the markets, a flaw in perception, analysis, or
markets move. They have to readjust, and I think yesterday was a small readjustment. I don't look at this as a problem. You're talking about the tick-tock of the market. I don't spend any time on the tick-tock of the market. I'm aware of it, but I'm not, whether it's, the Federal Reserve eases another 100, 150, we'll see. I mean, I think I see more policies by more government that tend to be more inflationary than deflationary. And so with that in mind, it's hard for me to see another 200 basis points of decline in short rates.
I'm gonna use that. The tick-tock of the market is fine, but secondary. Larry, as always, thank you so much for joining us.
Welcome.
Larry Fink, BlackRock Chairman and Chief Executive. I'm going to send it back to you in London. We'll have plenty more throughout the day from Berlin.
Francine? Thank you very much indeed. Francine Lacroix at the Berlin Global Dialogue Forum, speaking to Larry Fink. The forward curve is wrong, and we're not going to get a landing. We're going to get a slowdown, but we're not going to get a landing. Stop talking about a soft landing. It's not a landing. A landing implies that we get a zero.
For me, it was more policies are inflationary than deflationary. That is not music to Chair Powell's ears.
Yes, we're sort of talking globally, wasn't he? But then he did bring it back to the curve and to expectations there. Yeah. I guess it's another way of him making that same point, that the market is expecting too much in terms of cuts. Doesn't necessarily mean the direction of travel for the Fed changes. Maybe just means they don't cut as much as the market is expecting.
The forward curve is wrong. He wanted to get that point across.
He came back to that one.
He wanted, but a lot of people are saying it. Yeah. The tails on inflation are pretty fat right now. Yeah. And you look at what is happening around the world today, striking the United States on the East Coast, what is happening in the Middle East at the moment, the potential coming out of the US election, all of those things still exist. So, yeah, he is certainly paying attention. He's not paying attention to the TikTok of the markets, but I think Larry Fink is definitely paying attention. Let's pay attention to what is happening with the core 6 right now. This is what the picture looks like across Europe. Crudy was talking a little bit earlier about what's happening with some of the pharma stocks. They are doing well. You can see that on the left-hand side there. But luxury is under pressure. We've got a downgrade on Caring today. We've seen a decent performance over the last few days. That is unwinding a little bit today. Tech looks like it's on the front foot as well. Let's figure out what is happening with some of the other single stocks.
Absolutely. So those are the core 6. Let's go to the other movers. There's been plenty of news flow to keep Joe Easton busy. Joe.
So one stock keeping us busy, Anna, is Covestro. That's the big M&A story of the day. Abu Dhabi National Oil Co. sealing that deal for the company. But it doesn't look like we're rising up to the bid price at the moment. It is trading below that. Maybe that's telling us something about some execution risk on that one. But it is the German chemicals company, one of the best performers on the stock 600 today as they announced that big deal. It was reported by Bloomberg, of course, last night. And then we've got a statement, an official statement on that today. But the stock heading up around 4% over in Germany. Then going the other way, we've got Haleon, the maker of paracetamol, and Advil coming down 1%. Pfizer offloading £2.4 billion worth of the stock, putting that through the shares this morning. So it is weighing on it. It was at a discount. So we're coming down again, not quite coming down to the actual price of that, but it is a chunky sell from the firm and the long list of sales in terms of offloading some stock in that. Then we got Greggs, a shocker. It's a Greggs update, and it's actually not that strong. Greggs is normally one that keeps putting out really strong results, but actually the sales have started to weaken. They are very excited about their iced pumpkin donut. They do mention that in the statement, but that's not enough to lift the stock this morning. We're coming down 5%. Jefferies is saying in a note that, in fact, it is a bit of a remarkable slowdown from the year-on-year period. So that is weighing on Greggs this morning. Bit of disappointment there. Then in terms of Vestas, another one that's a bit disappointing. They had some orders in terms of wind turbines last night. This is over in Denmark, the biggest maker of wind turbines around the world, and that one is weighing on the stock today. So that one's coming down 2.4% this morning. Then we're going to look at beer, because one of the big broker moves this morning, we've got AB InBev, the maker of Budweiser, of course. Now, remember, there was a big slowdown in the Budweiser volumes on the back of a bit of a social media storm last year. Now, Citi does not think that Budweiser sales will recover to previous levels, but they say the margin outlook is improving, and that should actually help to expand their profits in the year ahead. So they recommend buying that one. That one's gaining 2% as Citi upgrades AB InBev. And as Guy mentioned earlier, in the luxury space today, Kering comes down to sell. That one falling 2.6. This is at Goldman Sachs. Goldman had a note on the luxury space around a week ago, and they did warn of weakening sales across that space, as a number of banks have done, and therefore they're now downgrading Kering as well. That one declining today. We've done luxury goods, sausage rolls, and also beer. So we've hit all the bases. Kering coming down 2.4% this morning.
Joe Easton from our equities team, we thank you so much for giving us the roundup and making us slightly hungry in the process. In the meantime, let's bring you some live headlines coming out of Brussels at the morning. It looks like Mark Rutte, the former Dutch Prime Minister, now going to be the new Secretary General, officially taking over the reins from Jens Stoltenberg. He's making some comments over at NATO HQ, saying they will be able to work with both Trump and Harris, but emphasizing the need to invest more and close capability gaps. And of course, this is something we had heard from just Larry Fink as well, talking about more infrastructure spending as well, and just again the need to invest in Europe. We hear it over and over again.
They need to invest. We also heard from Draghi talking about this as well. That was one of his key planks when he talked about his plan. Europe needs to invest in its own defence capabilities. The question is it a zero-sum game? Can you spend here and still spend over here? Or if you're going to spend on defence, do you need to maybe take away some of the money from elsewhere?
And how do you do it with the fiscal handcuffs that are, I think, the issue plaguing several nations? France, of course, top of that list. French Prime Minister is where we go next. Michel Barnier is reportedly planning to raise up to 18 billion euros as he looks to regain control of the country's finances, according to the Le Parisien newspaper. He will also push back a budget deficit target ahead of his first policy speech to Parliament later today. Let's get the details with Eleonora Mavariti from Bloomberg Economics, based in Paris for us. Eleonora, walk us through some of these negotiations. How much will what we hear from Michel Barnier actually change perhaps the way this budget is interpreted?
Well, France is currently in a very challenging situation. The debt to GDP is very high, over 110% of GDP, and the deficit is huge. Now the new government will have to make ends meet and propose some fiscal consolidation to meet with the EU rules. What would that mean? What we estimate that means is 0.8 percentage points of increase in the primary deficit annually for the next 7 years. So that will be approximately close to 25 billion of extra revenues or cuts annually that needs to be sustained every year. This type of consolidation,
So, Eleanor, that's the budget challenge. What about the role of pension reform then? That's often talked about as something to watch when it comes to the French budget and getting it under control. Are we going to reopen conversations about that?
Well, it's not unlikely, given that both the two main opposition parties have revealed they would like to reverse it if they were in power. But we think that that's a risky move. The reform has increased the working age, and also accelerated the increase in the years of contributions, and it was supposed to have positive impacts both on the fiscal side, but also on the potential growth of the economy. Reversing it, we estimate that can have both impacts on the fiscal side, but also on the labor force. On the fiscal side, will decrease the fiscal revenues significantly, and we see that we estimate by 2050 it can increase the debt by 15 percentage points compared to our baseline. And in terms
Eleanor, thank you.
of GDP impact.
We'll have to leave it there. Eleonora, thank you very much for joining us. Eleonora Mavariti from Bloomberg Economics. Thanks for the preview. We'll keep an eye on Paris, keep an eye on what we hear from Michel Barnier, and whether he says anything that moves the spread of French bonds. Coming up, we'll talk about the consumer. eBay UK announces major changes as it attempts to take on competition from the likes of Vinted and Depop. We will speak to the general manager for the UK of eBay. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is the opening trade. Around 30 minutes into today's session, you are starting to see risk sentiment turn around a little bit. You're seeing stock 600 basically flat. The underperformer here is going to be those French stocks. That's where you're seeing a lot of the weight come down, although still green on the screen when you look at the FTSE 100 and the DAX as well. But those French stocks really taking the wind out of the sails in the broader stock 600.
And we've got that big announcement coming up, that big speech coming up from Barnier a little bit later on. We'll see what he has to say. Spending, taxes, all in the mix. Pensions, we'll be focusing on that 2 p.m. London time for that Prime Minister Barnier speech. The other story we're focusing on this morning is what is happening with the inflationary picture around the world. One of the big pieces of that is what is happening on the east coast of the United States. European shipping stocks firmly in focus this morning. U.S. dock workers walking out of every major port on the east coast of the United States, plus the Gulf Coast for the first time since 1977. We're back to the 70s. Let's tell this story with Bloomberg's Brendan Murray. Now what?
Well, now that the attention turns to the White House, the two sides are still very far apart. The union put out a statement shortly after midnight New York time that said the wage offer is nowhere near good enough, and they're also concerned about automation. Their not just their livelihoods, but their existence. So the two sides are very far apart. They haven't talked since June, so something's going to have to give. And the White House, the Biden administration, a lot of businesses are looking at the White House going, you got to step in and end this thing before it drags on for too long, because the economic damage is piling up. $1 billion to $5 billion a day, 75,000 containers a day go through these 36 ports. That's 500,000 a week. Before you know it, we're looking at a major congestion problem with all the inflationary implications, delays around the holidays.
Yes, so that takes us on to the impossible question, which is about the impact on the economy. And I say impossible because you set up the stakes, but depending how long this lasts, that has a real impact on how much disruption we see to the economy and how much, I mean, some of the activity will just be delayed, but some of it will be lost.
Exactly. So a couple of days, economists say, we're not going to see a huge dent to GDP. But if you start getting into, it starts depressing consumer sentiments, consumer purchases. The New York governor yesterday said nobody needs to panic. There'll be plenty of things on the shelves, which kind of, begs the question, maybe I should be worried about that if these ships are going to be waiting in the dozens or even hundreds for weeks or more.
Because I was reading in the story, sorry, could you just jump in, that 35 ships that are due to be arriving in the next week, and they just go to Anchorage. They just sit off the coast.
Now we know where to get our groceries. I want to ask about the political implications here, because in the last 18 months, this is not the first labor movement that we've seen. We've seen it in Hollywood, we've seen it in flight attendants, we've seen it UPS, and of course rail strikes. And each one of those times, to avoid the inflationary uptick, Joe Biden has intervened. It doesn't look like he's going to be doing it this time around. Is it as simple as not trying to lose the Labour vote in this election?
Yeah, I mean, the timing, we're 5 weeks today from the election, so the timing is very important here. He's at the moment, he's sticking with his I'm not going to intervene stance, but we'll see how long he can hold on to that. At some point, trying to protect the union vote is going to turn into the general public going, this is causing a problem for all of us. So we'll see how long he can hold out in supporting the union. At some point, something's got to give. Otherwise, the broader economy is going to suffer.
The shipping industry's got very good at being flexible over the last few years. The latest, obviously, is what is happening in the Red Sea. They go around South Africa. This is another element of the need for them to be flexible. Can they go elsewhere? Can these ships be unloaded elsewhere? What does congestion look like elsewhere? Is there capacity elsewhere? Canada's also on strike.
We're going to be keeping a close eye on what ships do over the next several days. At the moment, they can't really go anywhere else. It's too expensive. It takes too long to go to the West Coast. The West Coast ports are already pretty much at capacity, so there's no time savings, and certainly there's more costs to go around through the you got to pay to go through the Panama Canal. Yeah. So it just adds costs. So at the moment, the shipping industry will kind of decelerate. We'll try to slow everything down. So the bottleneck doesn't get so big, but the longer this goes on, the longer they will not be able to do that.
And Brendan, interesting that we're seeing European shipping companies down today. That is in the context of gains yesterday, though. Are markets going to price in higher pricing power and focus on that, or are they just going to say this looks disruptive? That's not good.
Yeah, you could read that as the strike is underway, and hopefully there'll be a resolution sometime soon, and we won't see a big increase in freight rates that would benefit the shipping lines. So yeah, we'll see how it plays out.
Okay, Brendan, thank you very much. Thanks for joining us. Our trade czar focused on supply chains globally. Brendan Murray, thank you for being with us. So if it's going to take longer, or if global trade is going to be disrupted to get things in from one part of the world to the other, then maybe you find other places to shop. eBay UK has removed fees for private sellers across all categories starting today. It comes after the e-commerce giant cut fashion selling fees earlier this year to compete with the likes of Vinted and Depop. Joining us now is Kirsty Kyogan, who is General Manager of eBay UK. Kirsty, nice to speak to you. Thank you for coming to talk to us. So let's first deal with what it is you've said you're doing today. Why are you removing these seller fees? What's been your experience of doing that elsewhere?
Yeah, so it's a historic day for us in the UK because we've really changed our business model, and it means previously there were fees associated with selling items on eBay, and today it means that now if you sell items on eBay, what you sell them for, you pocket all of that cash. You sell something for £20, then you pocket £20. And that was a big barrier for consumers paying fees, so we've removed that. We've also made it easier as well. So we've made it quicker to list. We've created tools so you can take a picture and remove the background. Right. We write the listings for you, made it easier and safer to shop locally. So we've really listened to our customers and tried to roll out as many changes to make it as easy as possible for people to embrace a circular economy.
Okay, and what do you find about when people sell more through you, do they also buy more? Because I also noticed you're bringing in this eBay balance function where you can keep your money on the site. I mean, you're trying to find more ways, I suppose, for people to not take the money that they make on eBay out of the eBay environment and to spend it with you as well.
Yeah, so we know that customers, or if you sell on eBay, you buy twice as much on eBay. And one of the pain points for customers, that for some customers, was that money that you would make when you're selling your items would go straight into your bank account. For some people, they'd rather store it up and save it to buy. It could be Christmas gifts, perfect time coming up, or it could be they want to buy other things
in their bank account.
Or exactly. And so we just wanted to give customers that choice.
Right.
Is this a response to Vinted? I'm not the prime candidate here, but my kids, I know people who are involved in this process, and it's quite competitive in terms of where you list stuff. Is this a competitive response, or is this a response to removing friction from the system?
Yeah, I mean, look, eBay has been around for nearly 30 years, so we're always having to change and adapt to what our customers want, and this really is a response to what our customers have asked for us. So, removing the fees, making it easier, and that's why we've made this move here in the UK.
How would you define consumer confidence at the moment? Kind of, what are you seeing? What are people buying? Is there a change? Is there a shift underway? Is there anything we can discern from what you see on the eBay site about, is it glass half full out there for most people or glass half empty?
Again, it is mixed, but there's a lot on customers' minds at the moment. So people have got less money. People also want to shop more sustainably and make more responsible choices. And so that's why shopping on eBay is a great way to buy into pre-loved or refurbished goods. So 40% of our GMV now globally is from pre-loved or refurbished goods. But it's also a great way for customers to make money as well. So we know, up to 50% of households are sat on lots of unused items. I'm the same. I've got lots of them. And the average consumer, the average household will have about £300 worth of items that they're just not using. So they could sell those, make some money, and also put those items into another home where someone's going to love those items.
I love getting rid of stuff.
I don't. I like keeping everything forever. Guy made the comment or compared it to Vinted. I'd like to compare it to perhaps Amazon as well. Where are you seeing the competition? Who are you up against here?
Look, as I say, we've been around for a long time, so we've always had lots of competition. And what I do love about what's going on with the competitive landscape is at the moment is encouraging more people to shop sustainably and not putting stuff in landfill. And so we look at all of our different categories. So we sell car parts, so we have a fitment service. We look for luxury shoes and handbags. We have an authentication service. We try to do the best we can in each of our categories and deliver an amazing experience for our customers.
So how do you bring the prices down further?
So ultimately, we don't own any goods. That's down to our marketplace. So we just try to make sure that we give as much sort of like coaching and all the tools that we can give to our customers about what items are selling for.
But from a private seller, you've removed the fees now. Is there a next step that you guys are looking towards?
For private sellers?
For private sellers, for the consumer, how do we bring that listing price lower?
So ultimately, if there's no fees, then it's up to the consumer if they want to sell that item for less. But ultimately, we just want to get more listings on, and that's why we've made it easier. So rather than listing one or two items, because it might have taken you a longer time before, we've removed some steps to make it easier. So hopefully, you're more encouraged to go and clear out your wardrobe, or if you're moving house, go and sell all those things on eBay. As I say, rather than go to landfill.
Less is more. Get rid of it. Get it out of the house. Firmly in favour of that. Kirsty, nice to see you. Thanks for stopping by to see us. Kirsty Keegan, General Manager, eBay UK. Thank you very much indeed. Talking of car parts, we need to talk about what is happening in the auto sector right now. Harold Hendricks is going to be joining us, Managing Director of Auto's Research City. He's going to be coming up next to navigate what is a bumpy road for the auto sector right now. Have you seen the car sales data this morning out of France? Again, super weak. We'll talk about that next. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. when you look at our audience base today, that we have like just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't we're owning this space?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. We are 44 minutes into a European trading session that shows modest gains. We weakened a little just half an hour ago, but actually back into positive territory only just on the stock 600. In terms of what we are seeing under the hood, though, European automakers in focus this week after Volkswagen, Stellantis and Aston Martin all delivered warnings of a bumpy road ahead for the sector. Our next guest says the caution is unsurprising. Harold Hendrickser is Managing Director of Autos Research at Citi and joins us now on set. Harold, nice to have you with us. So take us through, I mean, big picture here. There seem to be different issues for different car makers depending on where they're exposed. And what can you tell us that unites them all? I mean, for Stellantis, difficulties in North America, VW citing difficulties in China, Aston Martin talking about supply chain problems. I mean, what is the uniting problem that they are all facing?
The uniting problem is really that they're all coming from a really high base during COVID. Right? Overall, consumer demand was very strong during COVID. They had production problems, so they couldn't produce, what the consumer wanted to buy. So they had a lot of pricing power for the first time in, literally my career, over 20 years. Yep. Car companies have never had that much pricing power. So they were selling very highly priced cars at very, very strong margins. And I think they'd all extrapolated as if that would continue forever, and it just hasn't. So China clearly much weaker this year. Because they can't sell in China, they're selling more cars in the US, and so that's causing US discounts to start to go up. And now the last thing is in the summer, clearly orders in Europe have slowed very sharply, right? Europe was up nearly 5% in the first half of the year, was flat in July, minus 17% in August, and then this morning we've had France down 11% in September. Yes. So they were hoping for a much stronger second half in Europe, and that hasn't happened.
But putting it in the context of COVID makes it sound like we're talking about some kind of normalization. But given the move away from, internal combustion engines to EVs, that doesn't feel like we're in normal territory, and that seems to be wrong-footing a lot of people. So is this normalization, or is this something much bigger?
I think you're right. I think there's two levels, but actually most of the problems we're talking about today are about normalization. Right? The market in Europe hasn't come back to pre-COVID levels. The market in China is just more difficult than it used to be. And then pricing has just been too high. People forget, but car prices across the world, if you look at the ASPs for these companies, are up 35% in 4 or 5 years. Our salaries are not up 35%. Yep. So, in real terms, people cannot buy as many cars. And so the European market now is sitting at about 13 million units. We're stagnating at 13 million units. Pre-COVID, it was 15.5. We've lost 2.5 million units. If you're a car company, Volkswagen, 26% market share, you've lost 600,000 units. That's nearly 2 huge factories, right? And so they can't fill up the capacity anymore. So the industry is really, really different. And that's even before we go to Chinese competition. That's before we really transition to the EV situation, where, again, that's super difficult. The cars are too expensive. The consumer doesn't want to buy them. The governments have no money for stimulus. How are we going to sell all these EVs, right?
Politicians are beginning to get very nervous. You're hearing that across Europe. Germany is the epicenter of the action. The expectation is that we're going to be seeing some of these targets removed or pushed out. Is that the silver bullet here? Is that going to make much of a difference, or are we delaying the inevitable?
Yeah, really, really good question, and a really long, hard discussion. We, last week, changed our view from a 30% chance of a change in the European CO2 targets to now our base case is that they will. for exactly the same reasons as you're talking about. I think the European politicians, I mean, we had two horrible elections, frankly, in France and Germany for the governments that were in power. I think those politicians are starting to understand that, well, they're going to lose their jobs.
Yep.
So finally things, I think, are changing. And so I think the first thing will be that the regulations for European CO2 will be delayed to give us a much more sensible, frankly, time frame for the companies to be able to meet those targets. But then, also we need more stimulus. If you want people to drive BEVs, you have to stop them driving ICE cars. Why are there not more city bans, for example? We've got toll roads everywhere.
Because there isn't the infrastructure to go with that. There isn't the industrial policy that wraps around all of this.
Yeah, I mean, look, we don't have a strategy, a total strategy to build.
Just stop there. We don't have a strategy. Maybe that's where we need to be thinking about it.
Guy, that's really, really right. But the really disappointing thing, I think, for a European point of view is, we were ahead on the CO2 side. We saw that coming. We were first to push people towards BEVs, and we're not capitalizing in terms of the industrial base. We're not capitalizing in terms of battery factories, investments, all of these things. These companies should be winners in the BEV space, and right now they're not.
How much pricing power do they actually have? If we're talking about targeting American consumers in the absence of anyone else, how much lower can the prices go? Can they at all?
Yeah, you've framed it very nicely. So at the end of the day, pricing is essentially a function of the profitability, right? So if you're sitting at 10, 12% margins, then pricing is a little bit easier, and cutting prices by 3 or 4% is possible. Once you're down to, Stellantis yesterday talking about very low margins in the North American market for the second half of the year, at that stage pricing becomes much more difficult, right? People forget, if you give away 200 basis points of pricing, that's 20% of your normalized, maybe even 25% of your normalized profits gone.
Yeah.
Right? Pricing is very, very sensitive. So I think we're coming up against a situation where it's going to get more difficult, but the overall American market is still getting more difficult. And just to give you an example, before COVID, we were at 13% average discount, dealer discount, for the average car. Today, the average market is still at 7 or 8. So we're not yet at pre-COVID levels in terms of discounting. Given where inventory is, given people like Stellantis and stuff like that, I think pricing could get a little bit worse.
So what does that do to the design cycle and the innovation cycle when it comes to releasing some of these new models?
Yeah, well, so two things on that. Firstly, the Chinese are really showing us the way, right? So, generally speaking, the legacy car companies have had, new model cycles, 6 or 7 year, model life cycles, right? The Chinese are down to about 2 or 3 years. So they've really sped things up very, very significantly, and especially with the new technology, software, hardware, electronics going into the car. The life cycle has to be shorter because, the technology gains that they're making in those areas are so much faster, right? If 6 or 7 years is a lifetime, in terms of some of those products. For the legacy car companies, look, it's difficult. Profitability was super high last year. They all increased spending. CapEx and R&D spending is really high this year. Now that profits are coming down, they're going to have to look at exactly where they want to invest, and they may not have quite as much to invest for next year.
Harold, you mentioned how there's not enough industrial strategy in Europe. It seems to get a lot of mention. We talk about it a lot, and we live in a much more geopolitically interventionist world with the Inflation Reduction Act in the United States. So the precedent globally is there. What is it? What are the dots that are not being joined up here? What do the car companies tell you that they need to see?
Well, again, what does Europe actually want? Right? One of the things is we need consistency in policy, right? And so, putting these very stringent targets in for CO2 in the very short term and then moving them is also not helpful. These companies have been putting 80, 90, 100% of their investments into pure BEV. But they were hoping for a much more supportive environment that would actually generate the demand for EVs that we were all forecasting, which clearly is not happening. So that's on the one side. So we need to do much, much more for the consumer if we want them to go there. But secondly, on the industrial side, just like the Americans, if you want European batteries, then enable the Europeans to build European battery factories. And if that means that we end up putting tariffs on China, so be it. And that's what the Americans have done, right?
Is all the bad news in the price?
We think that, for this year, generally speaking, the auto sector tends to be strong. November, December, January, investors tend to buy laggards at the end of each year, hoping for a better year next year. With the interest rate cuts and stuff like that, I think people will hope for a better year next year. And I think that could build a little bit of hope value back into the car sector for the last 3 or 4 months of the year, particularly given that we're really rebased in terms of, short-term earnings expectations. So I think earnings could still be lower in 2025, but if we have 3 or 4 quiet months now after what has been a tumultuous 2 or 3 weeks, then I think there is some scope for recovery if that, overall economic sentiment can improve a little bit.
I feel like what I'm hearing is policy matters at the end of the day, and I'm wondering how much of the story comes out of the U.S. elections and, of course, what happens out of the EU as well. Harold Hendricks, will lead the conversation there, Managing Director of Autos Research over at Citi. We thank you so much. Let's talk about another area that's largely going to be affected by the U.S. election, of course, the geopolitics in this region as well. We did get headlines from the new NATO chief, Mark Rutte, speaking about really the need to invest. It's, again, this theme we've explored not just through the show, but I want to say for years now in Europe as well, saying they'll be able to not only invest more, but try to close capability gaps, and will be able to work with both President Trump and Vice President Harris as well. Bloomberg's Max Ramsey took a deeper look at the challenges the new Secretary General faces.
He's one of Europe's longest-serving politicians, known for his positive nature and ordinary lifestyle. Mark Rutte used to cycle to work during his 14 years as Dutch Prime Minister. Now he's heading for one of the toughest diplomatic assignments that exists. With war in Ukraine, the redefinition of Europe's defense, and soon, a new U.S. administration. Compared to his predecessor, Rutte is expected to be more hands-on.
And a lot of good things are happening.
He managed to keep former President Donald Trump on side in his last term, despite his fiery criticisms of NATO.
Let's stop whining and nagging and complaining about Trump, whether he might return or not.
His ability to compromise is seen as key.
Mark Rutte is a pragmatic coalition builder. He will need a lot of that because NATO is very much about coalition building.
He's been an important figure in securing support for Kyiv, influenced by the Malaysia Airlines MH17 plane crash in 2014 in Ukraine. It killed almost 200 Dutch citizens, and the government blamed Russia. Now he's led the way on sending F-16s to Ukraine, bolstering his reputation as a political force to lead the alliance through uncharted waters.
Bloomberg's Max Ramsey there talking about the change of power over at NATO. Mark Rutte taking over the reins from Jens Stoltenberg, again, as the head of NATO. Let's talk about what else we're going to watch out for today on the agenda. 10 a.m. UK time, we do get that Euro area CPI data as well. But I think the highlight for today is going to be at 2 p.m. Michel Barnier's policy speech is going to be coming up. There's a lot to debate there, especially when we're talking about the budget, migration, not to mention the politics with his own country. We've got Nike earnings after the bell as well. And not to mention what's going on over the States. The U.S. VP debate, 2 a.m. UK time if you're awake.
Absolutely. And we will certainly have coverage of that this time tomorrow, won't we? It strikes me, thinking of the election, Mark Rutte now joining NATO, taking on that role, saying they'll be able to work with both Trump and Harris. We heard from Larry Fink earlier on in the program, downplaying the relevance for investment allocation of the U.S. election, talking about how, asked you deploy capital differently under Trump or Harris. And he just said, well, at the margin, but he thinks that maybe we exaggerate a little what difference that will make.
Those are two different conversations. The executive in the States has the authority when it comes to foreign policy in a way that it's different, therefore, for Rutte to handle. When you're talking about investment, everybody I'm talking to at the moment is telling me they expect that actually we're going to see stasis. You may see one party taking the House, one party taking the Senate, maybe a different, kind of one of those two taking the White House. There's going to be gridlock. From an investment point of view, that sounds...
That's what Larry Fink is maybe
precisely, that's the Larry Fink kind of world that we're moving into. But from a foreign policy point of view, with tariffs and all that other stuff, and what happens in Ukraine and what happens in the Middle East, that's where the difference could be.
Well, this is also where is tariffs the right approach? And this is, I think, what's crucial about the Harris administration as well, if we do get one, is largely a continuation of what might be Biden's policies. That includes maybe the extension of tariffs on someone like China, but quotas or other kind of mechanisms on places like Europe. Remember, there's still steel quotas at the moment hanging over Europe, and that's one of the first things that Europeans have to figure out with their U.S. counterparts. There's a lot to digest, 37 days till the election, lot to play out between now and then. That does it for the opening trade. The Pulse is up next. I believe we're on the ground in Berlin, live at the Berlin Global Dialogue. Stick with us. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Dog walkers walk out of every major port on the U.S. East and Gulf coasts, threatening the world's largest economy weeks before the election. Israel says it has begun, quote, targeted ground raids in villages close to the border in southern Lebanon, despite international calls for restraint. Plus, Fed Chair Jerome Powell says he's in no hurry to lower rates, while reiterating the United States economy remains on solid footing. Welcome to the program, everybody. Let's take a quick look at what is playing out in front of us in terms of the European session. We're sort of either side of the flat line here. The FTSE 100 up by 0.4%. The DAX a little stronger. The CAC 40 on the back foot today. We see some of the luxury names under pressure. We've seen a downgrade to some of the luxury players from one of the banks, and that could be weighing on Paris just a little bit. Broadly then treading water overall for European equity markets. In terms of individual assets we're focusing on, this is the features picture for the US. This the epitome of treading water, really waiting for some direction here, watching the strike action taking place in the ports in the on the east coast of the United States and down into the Gulf as well. Also watching geopolitical developments, of course, and with that in mind, quickly checking where we are on Brent. We're actually a little weaker now. We did tick up a little overnight on the Brent price, but now at 70.86. European gas futures also a little bit weaker, and dollar yen dictating the direction at least a little of the Nikkei, as we saw in Asia trading overnight. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in London. Francine Lacqua will be with us this hour. She's at the Berlin Dialogue, the Berlin Global Dialogue. We've already heard her in conversation with Larry Fink this morning. Plenty more coming to us from Francine and that dialogue as we go through this program. Let's turn to geopolitics. Israel says it has begun what it describes as targeted ground raids in southern Lebanon, defying international calls for restraint. The military has been striking targets in villages close to the border that pose what it says is an immediate threat to communities in northern Israel. Let's get more now with Bloomberg's Stuart Livingston-Wallace, who can bring us up to date from the region. Stuart, an update on what we're seeing overnight from Israel and the objectives they describe attached to this operation.
Yeah, good morning, Anna. So at the moment, it's very hard to tell what exactly is going on. We know we've seen some reports of explosions on those villages, as you mentioned, along the border. but there have also been similar incidents along the coastal areas and again in Beirut. So just to remind everyone, this sort of comes at the tail end of a couple of weeks of really very intense airstrikes in Lebanon. And that's really aimed at two things. One is to eliminate the Hezbollah leadership. And so far, Israel says it's eliminated something like 10 out of 11 of the most senior leaders. And secondly, to degrade the weapons stockpiles that Hezbollah has across. So most of that has been focused on the Bekaa Valley and then the southern suburbs of Beirut, because those are the Hezbollah strongholds. But what you've seen this morning, I think, is a realization from Israel, or an acceptance from Israel, that airstrikes alone are not going to be able to do the full job in terms of eliminating that threat to its citizens in the north of Israel. So fundamentally, Netanyahu, the Israeli prime minister, expressed one of his war aims is to be able to move his citizens back into the north of Israel. So they've evacuated from there for many months. And that is really fundamentally what they're trying to do here. The real risk is how long they have to stay to get that done. And really, they may get bogged down and find themselves back in the same situation they were a couple of decades ago, where they had to effectively stay in southern Lebanon for years and years. That is not the intention here. That is clearly not their stated goal, but that is one of the risks.
Stuart, thank you very much. Thanks for the update. Bloomberg's Stuart Livingston-Wallace with the latest on what we're seeing developing in Lebanon. You can follow what is happening, the latest coming to us from the Middle East on a Bloomberg Top Live blog. That's on the web and on the terminal with the latest on the Middle East situation. TLIV Go is the function to use on the Bloomberg terminal, or you'll find it on our website. Let's just get to some breaking corporate news coming through, and this coming from Lufthansa, the CEO speaking at a press briefing. He's talking about the gap. Says that the gap between the group and Lufthansa Airlines has widened, says overall traffic figures have been strong, but then makes that point about the gap between the two, says that the namesake airline continues to hurt earnings. So a focus on the performance of Lufthansa there. I saw earlier on overnight they were talking about their Middle Eastern operations and extending their suspension of Beirut flights to November 30th. But the subject of this briefing seems to be around the performance of the business. That does not seem to be denting the share price right now, up by over 3%, with the oil price down 1%. Perhaps that has held sway. Let us talk about macro policy, monetary policy. Fed Chair Jerome Powell has emphasized that the overall U.S. economy remains on solid footing, setting the table for further cuts.
Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting.
I'm joined now by Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, for thoughts on what this means for markets. Karen, good to see you. So did you take anything new from Jerome Powell yesterday? I mean, some reports I was reading said, quote unquote, he was a tiny bit hawkish. I'm not sure what a tiny bit looks like to you, whether that's how you describe it. But was it a sort of material update, or is it steady as she goes for you in terms of cuts?
I think the steady as you go part is this whole narrative the Fed have created around our central projection is our war against inflation is won, and therefore we can get back to neutral as quickly as possible. And he reiterated this point about neutral. The Fed, I would say foolishly, give us an assumption of what neutral is. It's much closer to 3. So he's sort of painting this idea that we don't need to be on the brake anymore, so we're just going to ease off and we can get there as fast as possible. Perhaps the slight angle, which is the little bit of hawkishness, is this sort of two-sided risk, and also perhaps that they're not in a major rush. You know, the difficulty when you start off with 50 is that the market, you know, how you control what the market expects about the pace going forward. Yeah. So maybe they're just trying to bring a little bit more gradualism into some of the forward expectations, where there's still, you know, an awful lot of very rapid cuts priced.
I don't know whether it's, you know, when is the right time to look back at that 50 basis point cut and say, was it the right thing? When we need maybe more benefit of hindsight. But when you look back, when you look at that now, did it make sense to you at the time? Does it make sense still that they started with 50?
No, if I'm honest. I mean, to me, they really started cutting in December, back when Jay Powell gave us that significant pivot, really gave us the statement that they felt comfortable they were winning against inflation. If you look at what happened to financial conditions from December, they already started really improving. So credit spreads tightened significantly, mortgage rates fell. So the sort of impulse of monetary policy through the economy was already being felt from December because the market priced these lower rates. For that reason, I didn't think they needed to particularly rush. I felt that, you always risk creating a sense of panic. And, some of his statements last night were, look, everything's fine. The US economy is fine. So maybe, again, he's trying to reel back a little bit on that. I didn't see the rush and the urgency, given it was already sort of that 100 basis points was already priced. But, you could argue, look, they're being preemptive. They're getting ahead of the game. They're not taking any risks with growth. Yeah. And that's why the stock market loves it.
Yes. Let's focus a little on Europe and how Europe should respond, because, of course, monetary policy setters, they don't want to just follow each other, but they also don't set policy in a vacuum. Yeah. So what does this mean for the ECB then, and with your focus on allocating around European assets?
Yeah, I think the ECB should just get cracking. To me, the US globally, we had a supply shock. We had a cost shock to inflation. But the fiscal response in the US was so massive that the US also had a demand shock. So the Fed were really right to have to lean hard against that. I think in Europe, yes, you also have to lean against a supply shock, but when it's really clear it's passing through and headline inflation is down, then you start easing. And I think the ECB really need to get cracking. The economy is weak. Just look at the data we're getting out of Germany. And I think now that we will see wage inflation follow headline inflation down quickly. It's a very indexed type of wage negotiation process in Europe. So I think the ECB should get moving now.
Yeah, so what opportunities, with that as the backstory, are there opportunities to invest in Europe at this point, Karen? Is it attractive? I mean, we saw, yes, the PMI data confirmed today for Germany and for France, that very negative story that we saw coming out last week.
Yeah, I mean, we were pretty bullish on Europe at the start of the year for two reasons, one of which is proving right and one of which is proving wrong. So the reason that's proving right is that we felt that we were finally going to get our post-pandemic consumer bounce, headline inflation falling, real wages improving, confidence rising, and that broadly is playing out. The part of the story that is not is manufacturing. We felt also we were going to be on a global goods upturn and Europe was really going to benefit, and that isn't playing out. Global goods demand is still very weak. The weakness of China, I think, is part of that story. We felt that China would have been on a better upturn, so that's proving a bigger drag. But, when it comes down to asset allocation, it's always about what's in the price, not just what the outlook is. And I think if we look at the historic low valuations on Europe, then that suggests there's an awful lot of bad news in the price. And I also think that for investors should be thinking about how to diversify away from the concentration of tech in the US. Yeah. And therefore, I think Europe is a good place to go.
Does that take you to somewhere as beaten up as the European auto sector then? I mean, there's certainly a lot of bad news in those prices after the week or weeks that we've had of negative news flow.
Yeah, I mean, there's something else going on here, which is partly related to this goods. I think Europe really is at a bit of a crossroads, because I think Europe needs to wake up and realize there's two things the rest of the world is doing that we're not doing. And we think it's because we're being sensible, but we're just destroying our domestic industry. So the two things we're doing are we are, focused on saving the planet and climate regulations and reaching net zero. But when the rest of the world isn't meeting you on those regulations or those carbon pricing, it's really penalizing domestic industry. The other thing the rest of the world is doing is handing out subsidies left, right, and center. And we know that Europe was very hesitant to follow the Inflation Reduction Act. We're much more worried about debt levels here in Europe. The rest of the world isn't, so it's like going to a party and, behaving yourself. It's the right thing to do. You're not going to have a hangover in the morning, but the rest of the world's having a better time. So I think Europe really has to think about how it's going to support domestic industry when the rest of the world is doing different things.
Okay, Karen, nice metaphor to leave it on. Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. Thank you for being with us. Coming up on the programme, as promised, we will be live at the Berlin Global Dialogue. Francine Lacroix will be speaking to KKR's Philippe Fritz about investment opportunities in Europe. That's coming up next. This is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, good morning, everyone. From the Berlin Global Dialogue, I'm Francine Lacqua. Now, despite the economic doom and gloom in Europe, investors are still looking for opportunities. Now, some of the biggest names in private equity are here at the Berlin Global Dialogue, including Philipp Freise, the co-head of European private equity at KKR. Philipp, as always, thank you so much for coming on. Now, look, M&A in private equity has frankly not been easy. How do you read the situation?
Francine, first of all, thank you for having me. Good morning. Well, as you pointed out, the period between 22 and 24 in the summer was a rather slow period. However, we have experienced a significant uptake now. I think we are up 40% year on year. So as we had previously discussed, that lull would at some point be followed by more activity, and we're seeing that right now.
So where do you see opportunities? And is there still a price mismatch? I remember speaking about this with you as if it was yesterday. Has the buyer's expectations come down?
Well, KKR is constructive on Europe. This year alone, we have invested 25 billion euros here on this continent. Telecom Italia in your country, but also in private equity, a significant equity deployment of 6 billion euros so far this year. And where we see the opportunities, this continent has unprecedented disruption. We have a war, we have an energy transition, we have a technology disruption on a massive scale, and lastly, a generational handover, if you will, that hasn't been precedented here. And people are open for private equity to help them with all of these challenges. So as KKR, we really are positive on partnering with our, potential targets to help them, cope with these challenges.
Family-run businesses
yes.
in certain sectors, or just opportunities that look cheap?
So I think, as you pointed out, people are negative on Germany right now. I would be a bit more positive. The innovation power of the German Mittelstand, so family-owned companies, is unparalleled. They have built global niches. Yes, they need to change. Yes, they want to change. But yes, they are also open to work with us. So I'll give you an example. We have just partnered with OHB, the kind of noteworthy German space company in Bremen. The family had 70%, 30% was public. We now took it private. They are still 70%. They didn't sell a share. We took the 30%. And we will help them get into the future in terms of the space economy. They want a partner that is more active than the public markets could be. So to answer your question, it's tech. Space is only part of that tech ecosystem. It's energy transition. Fiesmann did that massive deal with Carrier where they sold their firm, but they are now going back in. They've partnered with us on Encavis, which has 190, new energy.
Philip, when you look at Germany, it's seen as a segment of Europe right now for a number of reasons. We saw, for example, Volkswagen looking at shutting factories, Intel actually not putting that investment straight away that it promised, flatlining growth, if anything. Do you see more opportunities in Germany than elsewhere?
It's a wonderful reminder. Last time Germany was called the segment of Europe was 2003. And you remember the reforms, the change that was deployed. We helped with that at that time. As you remember, we did many German deals, DMAG, Mannesmann Plastic Machines. I just mentioned in Carvis, the energy transition. People call it challenged. I wouldn't go as far as calling it the segment of Europe because of that energy transition. On the current trends, in 2030, Germany is going to be through with it. But it's a significant investment opportunity, which we're helping. I wouldn't call, you saw the deal this morning where ADNOC bought Covestro.
13 billion, so it's not an insignificant deal.
Indeed. People wouldn't invest in Germany if there wasn't opportunity. It still has all the advantages, but it's much more open to change now. It wants entrepreneurial capital, so it's, in our mind, a very attractive opportunity.
How much money do you have to deploy here? I know that you wanted to double maybe some of, I don't know whether it's deals or also staff in Europe to try and find the best opportunities.
Well, KKR has invested in Europe for 25 years. We have not only a private equity business, we have an infrastructure business, a credit business, we have a high net worth, fundraising business. We are all over Europe. We have significant funds in private equity alone. Unlike others, we have a standalone European fund, and therefore the capital to be deployed here in Europe is not a bottleneck for us. In fact, we want to invest more.
Okay, Philip, thank you so much. Philip Freise there, the co-head of European private equity at KKR, stays with us, and we'll talk maybe a little bit about private credit and some of the other opportunities. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back, everyone. We're in Berlin, still with Philip Freise, the co-head of European private equity at KKR. Philip, thank you so much for sticking around. Are you seeing increased pressure from investors to actually return capital to them?
Well, we just returned about the impact of this unprecedented volatility. It actually has created now an opportunity to deploy more capital. We are up 40% year on year. But indeed, because of the uncertainty, the IPO markets are still shut, pretty much. There are some timid attempts now for companies to go public, but not at the scale that we are used to. It's still down more than 50%. As a result of that, everybody is finding alternative ways of returning capital. It's certainly up as well in terms of the return of capital, but it's more through longer-term hold periods, selling minority stakes, and yes, strategic buyers also coming back in the market timidly. Indeed, the liquidity that we are seeing more on the buy side is not matched by, liquidity on the sell side. So indeed, that's where we will see more activity. I believe once we have some of the elections behind us, 25, we'll see more activity.
I mean, is that a catalyst? Would that be a catalyst, or do you need something for animal spirits? And does that go through also interest rate cuts?
I think animal spirits always happen. We just talked about Germany, right? If it was true that Germany was so challenged, why do we see all that activity right now with Commerzbank, with Covestro, with our industry being really active? It's because that type of turmoil creates opportunity. So indeed, 25, I think people now discounting very much. We had a Ukraine war. Now we have a very unstable situation in the Middle East. You cannot hope for that year to be without any crisis. But we will have less political uncertainty because some of the elections will be behind us. So yeah, that should be helpful.
Philip, how does the demand for private credit actually change the multiples or how you look at private equity?
So the credit market is fundamentally changing. Some markets are still very much banked. Japan, which is one of the markets which our industry is very focused on, compared to the US, has a much more banked market still. The institutional market is not as advanced. Germany, similar. Europe is probably in the middle between the US and Japan. Private credit is a significant opportunity in Germany. We have a big business here as well in it, and it's definitely helping German companies or European companies to finance themselves in a more sustainable way, being more independent of the banking market.
Philip, thank you so much for joining us today. That was Philip Freise, the co-head of European private equity at KKR. Now, coming up, our exclusive interview with Thomas Schinecker, the chief executive at Roche. The pharma giant talks to Bloomberg's Anna Edwards to discuss the firm's industry outlook, new drug development, and more. That's next, and this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning and welcome to The Pulse. I'm Anna Edwards in London, in for Francine Lacroix, who is with us, of course, as you just saw. She's at the Berlin Global Dialogue. More from Francine as we go through the programme. These are your top stories this morning. Dock workers walk out of every major port on the US East and Gulf coasts, threatening the world's largest economy weeks before the election. Israel says it has begun targeted ground raids in villages close to the border in southern Lebanon, despite international calls for restraint. And you're looking at live pictures from Brussels as the former Dutch Prime Minister Mark Rutte has succeeded Jens Stoltenberg to become the Secretary General of NATO. Let's move on to corporate news flow. And the Swiss drug maker Roche says it's aiming to deliver 20 new medicines to address diseases that rank among the biggest burdens to society this decade. The new goals are the result of a more than year-long overhaul of the company's research and development, as Chief Executive Thomas Schinecker targets a fresh direction after a series of failures in cancer and Alzheimer's disease. I'm pleased to welcome Thomas Schinecker to the programme for an exclusive conversation. Very nice to have you with us. Thomas, thank you for being here with us in London. I know you've been talking to investors, presenting your new plan. If I could zoom in on one area of focus, because the market's got itself very excited about the potential for obesity drugs. You are in this space. You did a deal with Carmot. What space do you think there is for Roche, given how busy it is with lots of other competition for obesity treatments?
Well, obesity will make up about 50% of the world's burden in terms of the population. So 50% of the world's population will be obese in their 30s. So that's a huge problem that we have to face as a society. The issue with obesity is that it doesn't only affect, the fact that people get overweight, but actually the problem is that it affects so many other diseases. Diseases such as cardiovascular diseases, diseases such as cancer. We know that people that are obese develop a higher chance for getting cancer. Other diseases like Alzheimer's, Parkinson's disease. So you see a big link between obesity and a number of other diseases.
And that's the urgency, but there's a lot of GLP-1s out there on the market already. You've got your own play. What space do you think there is for Roche in this?
Well, on the one hand, we have very good molecules which have a very high efficacy, and they're very differentiated. We have an oral version and injectable version. And on top, we believe that the medicines that are currently on the market will actually not serve all the needs that patients have. For example, there is a reduction in muscle mass in patients with the current medicines. So how do we fix that, right? How do we fix that people can stay at the level once they reach the level that they need to reach? Yeah. So there are a lot of opportunities to address that. And on top, co-formulations with other medicines to tackle diseases in the heart, but liver, kidneys, etc. So we believe it's kind of a backbone in order to address a number of different healthcare challenges in the world.
So is this a deal story for Roche? Is this something that means you have to go out there and buy other businesses to play your role in this space?
No, in fact, when we did the acquisition, we saw that we had more than 5 different medicines that we actually want to combine the GLP-1s with. So we actually have a very good pipeline that fits to the GLP-1 GIPs.
Okay, and when you brought out some early stage data quite recently, we saw the shares rise on the back of that, but then the shares went down again on the back of some further data and some further news. The market is very volatile around these kind of research reports. Are you learning quite a lot about the best way to communicate to the market around this exciting but also slightly hyped sector?
Yeah, so whenever we have news in-house that could be market relevant, we have to communicate it. It's a legal requirement. So that's why we very much keep to what our legal colleagues tell us. And we saw it, right? We saw that once we communicated, there was a lot of, happiness and support about these kind of molecules coming to the market and having more options than just the 2 options that are available today.
Yes.
Regarding the later data that was published, one thing that people have to be careful of is not to compare apples with pears, right? This was stage 1 data. In stage 1, you actually up-titrate very fast the dose, which you would not do once you give it to patients once the medicines are on the market. So you can really make sure that the tolerability is in a very good shape if you titrate slower, and it has no effect on efficacy because the efficacy is really specific for the molecule itself.
Okay, yes, because that second part of the conversation was more about the ability to tolerate the medicines and how people
and they're
might
very
respond
tolerable once you up-titrate slow.
Okay, again, just lingering on this for one more question. Zealand Pharma in focus for some people, and they have an amylin asset that you don't have. From what you've said, it doesn't sound like you want to do more deals in this sector, but some analysts are talking about whether that kind of company might be an attractive partner of some form for you.
Yeah. So we have a number of different molecules in our portfolio right now. Some of them we've disclosed, some of them we have not disclosed. So we have never said we don't have an amylin in-house. So that's the first piece. The second piece is we have, for example, an anti-latent myostatin antibody. This antibody actually helps to preserve the muscle mass for these patients. But again, the problem with patients who take these GLP-1s is they lose a lot of muscle mass. So once they stop taking it, it's worse than before because the metabolic rate has gone down even further because they need the muscles to burn that. So we have a really great asset in-house we want to combine this with. Plus, yesterday, our head of development for the cardiovascular metabolic franchise presented data on one more asset that we have not yet previously shown to the outside world, with which you can even get deeper response in terms of weight loss. So we have a number of things in the pipeline. Some of them we've shown.
Yes.
2 of the examples I gave. A lot we have not even disclosed yet.
Okay, so it sounds like you don't need M&A on obesity.
Well, look, we are always open to look at things, right? I think that's part of the job that we have.
Yes.
We always need to look at different opportunities, but we say no to 99.999% of the topics. Right?
Okay, we are moving towards a US election, of course, and drug pricing often becomes topical. And in the run-up to that, we're seeing quite a lot of pressure on those that already play in this sector, taking part in hearings in Washington, for example. On US drug pricing, is that, and the fact that we might see negotiations around pricing on Wegovy as early as 2025, is that influencing your thinking around the opportunity in this sector at all?
Well, first, we're an international company. So we don't only look at the US when we look at serving patients' needs. Second, in the US, we have a tradition and a history that we've always priced our new medicines below the standard of care. So we are definitely taking our responsibility to make sure that there is the right pricing in these markets.
And looking at other drugs and other opportunities, you've also indicated, I started this conversation talking about a whole range of diseases and things that you want to tackle. You've indicated an interest in antibody drug conjugates for cancer. I wonder what opportunities you see within that space.
Yes, so we just recently did a deal for ADC, so antibody drug conjugate for CMET. So there is, it's an interesting space, and we have a couple of things in our pipeline, but it's also a space which we have recently seen. It doesn't mean that everything is going to work. So you have to have your due diligence, you have to go through the different stages of clinical development, and then you have to pick the right ones. And so it's not a home run as we've seen lately as well.
Thomas, thank you very much. Thank you for joining us. Good to speak to you as you pass through our offices here in London. Thanks to Thomas Schinecker, the Roche CEO. Coming up in the programme, we will be hearing from Eric Cantor, Vice Chair of Moelis and former Majority Leader in the US House of Representatives. Stay with us for his thoughts on the US port strikes ahead of tonight's vice presidential debate, of course. He'll be speaking to Francine shortly. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Welcome back, everyone. Now, dock workers have walked out of every major port on the U.S. East and Gulf Coast in a dispute over their wages and contracts. Now, the strike could add uncertainty to the U.S. presidential election and comes ahead, of course, of tonight's vice presidential debate between Tim Walz and J.D. Vance. Well, joining us now is Eric Cantor, Vice Chair and Managing Director of Moelis, a former Majority Leader in the U.S. House of Representatives. Thank you so much, Speaker Cantor, for joining us. I mean, there's a lot going on in U.S. politics, and the strikes certainly add a lot more strife and uncertainty to it. How do you see it playing out?
Well, Francine, it's great to be with you. I mean, unquestionably now, as we see the dock workers go on strike in our country, it is going to add just yet more pressure to the economic worries that are at the heart of this election battle. As we know, this administration has been battling with pretty significant inflation that's impacted working families across the country. And if the two sides are unable to resolve the dispute around the dock workers and the ports in our country, you're talking some significant inflationary pressures and some backlogs in terms of supply chains in the country. So I don't think it's a good turn of events for the Biden administration and for the Harris campaign right now.
You have two candidates, two different economic agendas. How will they change their policy to deal with strikes like this?
Well, I think what is sort of the new arrival of a new situation where you actually have President Biden, he showed up on the picket lines, as did President Trump over the summer when the auto workers had gone on strike in Detroit. So increasingly now there is some type of relationship and or support that both sides are giving to workers as they face the rise of cost of living across our country. So again, this is the heart of what the election's about, and why I think that Kamala Harris is on significant defense on the most important issue this election, which is inflation in the economy. And this port strike certainly doesn't help matters for her campaign.
Why is U.S. debt actually not being talked about in this presidential campaign on either side?
Well, you know, it is an amazing thing right now, given the type of debt and deficit that the U.S. Is incurring. This year, we will be at about 3% of net interest costs to GDP, and that is historically the point at which there is a fiscal reset in our country. I do not think that there's a will for that to happen at the policymaking level, even after this election with the installation of the new Congress. And I think, Francine, somehow or another, it's because the U.S. economy has proven continued to be resilient with the creation of more jobs. Obviously, it's a much more constructive environment from a business standpoint going forward with the inflation coming down. Interest rates, obviously, the direction of which has now been signaled by the Federal Reserve. I think all that adds to really investor confidence about the United States.
Look, you've had some harsh words about President Trump. Do you still recognize your Republican Party?
Listen, I'm a Republican. I think President Trump will win this election. It is very, very close right now. And again, the terms of this election are really about the economy. It's really about whether the American people are going to want 4 more years of the same, which is essentially the message you hear from the Trump-Vance campaign, and or whether the country is going to take a step towards trying to restore some type of confidence and strong leadership. I mean, that's really what's on the ballot in the next 5 weeks. We're 5 weeks out from the election. And certainly the party has taken a much more nationalistic turn, but I think that is true globally. Right now we see increasing sense that we have to secure our supply chains. After the COVID pandemic, we certainly were awakened to the fact that China is a serious issue for the world and our supply chain, and certainly from a national security standpoint, our foreign policy has become increasingly focused and prioritized on the issue of the U.S.-China relationship, and that will continue.
President Trump is also talking about putting in question the independence of the Fed. There's talk about 100% tariffs on nations that don't comply with the U.S. demands. Do you have worries about some of the rhetoric around this campaign?
You know, if there's one thing that President Trump has been consistent about, I think pretty much throughout his business career as well as his time in the White House, has been on the issue of trade. He has consistently made the point that we in the U.S. have been put at an unfair advantage after the end of the last World War, and certainly after the demise of the Soviet Union. I think people were lulled into this notion that somehow globalization was going to cure all ills, and that somehow we didn't need to worry about our defense spending, our industrial base. All those things have sort of come to roost now, and realizing that all this costs a lot of money. And as our country looks to try and make those investments, I think what President Trump's argument is that others ought to step up and pay their fair share. And I think that's where his position on the trade and the tariff issue comes into play. So long as others are trying to step up and pay their fair share and pull their own weight, as we all gather together towards the increasing threat situation globally, I'm not too worried that ultimately those tariffs will actually be something that come into existence and last. We'll see.
But what does this America First policy mean for the rest of the world? And overall, if governments across the world are now prioritizing national security objectives over economic efficiency, Does it mean that the rest of the world and even U.S. allies will break away from the United States of America?
Well, you know, I think what has been going on post-World War, and certainly as we've all sort of benefited again from that post-demise of the Soviet Union, you know, I do think America has been central to the defense of international trade, to the open and accessible sea lanes, to the implementation of international law and the sort of normal rules that we've all become used to. But again, it's increasingly a global situation where countries are going to look to see what's in their own best interest, and they're going to look to count on the alliances that America has sponsored. And I would say, even though some of the rhetoric seems like America is going to go things on its own, overwhelmingly, I would say in my party, there is a strong sense of American leadership globally. And we've seen that play out in terms of the vote to support the effort by Zelensky in Ukraine. We've seen that in terms of the vote of support in terms of the Republican Party and, frankly, the Democratic Party in its support of Israel in its ongoing war with the Iranian proxies that are implementing Iran's Ring of Fire strategy in the Middle East. And I think that you're going to continue to see that kind of support coming from Capitol Hill, despite some of the rhetoric from the current White House with Joe Biden.
Eric Cantor, thank you so much for joining us today, Vice Chair of the Investment Bank, Moelis, and a former Majority Leader in the U.S. House of Representatives. Plenty more to come right here from the Berlin Global Dialogue, including more of our interview with the BlackRock Chief Executive, Larry Fink. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
I am a very large believer on a banking and a capital markets union. I think that's the strength of the United States. Europe needs to do that. I've read the Draghi report. Because we are large shareholders in both, I don't talk about any activity about one organization versus another. But technically, I look at the strength of the United States, and much of this strength is because of the strength of our capital markets and our banking system. Europe needs a stronger capital market system, and it needs a more unified banking system. And I think that's going to be urgently necessary for Europe to go to the next step.
Well, that was the BlackRock chairman, Larry Fink, speaking to me a little bit earlier. Joining us now is Chad Thomas, Bloomberg's executive editor for Europe. Chad, you're here also based in Berlin. Thank you for joining us. There's a lot going on with some of the German companies. I think ADNOC just made a big play, a 13 billion acquisition here in Germany. UniCredit is definitely going after Commerzbank. Where are we on German business?
Yeah, you have these German businesses that are in play where you have Covestro, ADNOC buying them. You have UniCredit trying to purchase Commerzbank. So there's a bit of concern in Germany about these businesses potentially being bought up and who's going to own them. At the same time, you also have issues with the German automotive industry. The German automotive industry, you can't underestimate how huge it is. 800,000 people are employed in this country in the automotive industry when you think about the suppliers and everybody else. And all of the German car makers are struggling. They've all issued profit warnings in the last couple of weeks. They're all struggling with the shift to electric vehicles. And most importantly, China. They're not doing well in China. China is their biggest market by far. Also the big profit center. That is where they used to draw in all the money regardless of what was happening everywhere else. They're struggling in China. They're not doing well with the EV transformation. And so you see the likes of Volkswagen saying that they may, for the first time, have to close a plant in Germany. They're also talking about doing away with some of these agreements that they have with workers that have been in place for decades in Germany. So you see a real shift happening in business here and also in the society as a whole.
Yeah, and this is against a very difficult political backdrop. I know you and your team yesterday broke the story that the German government is not really expecting any growth in the country.
Yeah, so we had the scoop yesterday that when they come out with their new forecast, they're likely going to forecast that it will be stagnation. In a way, it's not really a surprise because that's what a lot of others have been saying. It's the German government, in a sense, catching up. But what has happened, you've seen the rise of populism in this country. We've had 3 state elections in eastern states, and the far right has done very well. Also, the far left has done very well in these elections. And so the chancellor is really struggling to get through with his message. All of the parties in the coalition are doing very poorly at the moment. The Greens, who are in the government, they just tossed out all of their leadership. And we're 1 year away from a federal election. So it's interesting to see what's going to play out in the next year.
That's the understatement of the year. It's interesting. Chad Thomas, thank you so much. Chad Thomas, Bloomberg's executive editor for Europe. Up next, it's Bloomberg Brief, Danny Berger and Manus Krani in New York. And this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station. and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranny alongside Denny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
A major escalation. Israeli troops move into Lebanon, launching targeted ground raids aimed at Hezbollah. A message to the market: we are not in a hurry. Fed Chair Powell reiterates data dependence. Up next, jolts and PMIs. And an all-out strike. Dock workers walk out of every major port along the U.S. East and Gulf coasts. Good morning, Manus.
Danny, good morning. It was the Powell Gazette. We're not in a hurry to cut rates. I'm not in a hurry, and if everything else remains equal, 250 basis points cuts is what's coming. This is state of play on the equity markets. It was the bond market that woke up more than the equity markets. By the way, you know, we start the fourth quarter a little bit on the back foot, down by an eighth of 1%, but we added $2.5 trillion in equity value and wealth in the third quarter. Roll it over, have a look at the bond market, because this is where, as Larry Fink says, this bond market is crazy on the forwards. It's pricing in way too much cuts. We've just sat down with Larry Fink. More on that conversation a little bit later. Yields drop ever so slightly, and this is where the field of dreams really and rate cuts came to be, I suppose, rephrased yesterday by Jay Powell. You've had 5 months of a rally, the longest run up in terms of, down in yield and rally in bonds that you've seen since 2010. But a message from Larry Fink and the rest of the market: you're all just a little bit crazy on your forward curves.
Well, man, some good news for the ECB. Eurozone CPI breaking. First time it is sub 2% since 2021. Consumer prices rising 1.8% year over year. That is in line with the estimate. Core also in line with the estimate, 2.7%. And month over month, actually lower than expected. Month over month, CPI falls 0.1%. The estimate had been for it to be flat. This will reinvigorate those who think rate cuts are to come in October. Manus, we heard from Christine Lagarde yesterday saying that she has more confidence in inflation, and that bodes well for October, explicitly mentioning the month at the moment, 91% odds that they cut in the month.
And that was the magic words that came from Lagarde yesterday. They're going to take this drop in inflation into account in our next monetary policy meeting. The swaps went pretty aggressively, going from an 82% probability of a rate cut in October to 92%. So this is the clear trajectory for the Eurozone. Just look at some of the numbers. 1.8% in Germany, 0.8% in Italy. So this is disinflation writ large.
Yeah, and just to walk you through what the bond market doing, German 10-year yields lower by about 6 basis points, but we're seeing that across sovereign bonds. There is a rally this morning, maybe somewhat tempered by Powell yesterday, but at least in Europe, they have the green light.
Indeed. Well, geopolitics is front and center for us. Israel says it has begun what it describes as a targeted set of ground raids in southern Lebanon, defying the international calls for restraint. The military has been striking targets in villages close to the border that pose what it calls an immediate threat to communities in the north of Israel. Dan Williams is reporting for us from Jerusalem. Dan, look, what does Israel hope to achieve from this, as we understand, a targeted set of strikes to try and degrade Hezbollah's arsenal?
Hi, good morning. I'm actually not in Jerusalem, on my way up to the Lebanese border now, hence the unusual setting of this interview. What Israel hopes to achieve is the completion of the operation it launched exactly 2 weeks ago called Operation Northern Arrows. This operation is meant finally to dislodge Hezbollah from the border areas, to degrade its capabilities, and to decapitate its leadership. The last two aims we saw over the last 2 weeks. The first we're seeing now, because the declared war aim that Israel added a few weeks ago to this Gaza war that erupted almost a year ago was the return of some 60,000 residents of northern Israel safely to their homes. Those are people who left under Hezbollah fire almost a year ago. And to do that, it says it needs to physically go into some areas of the border on the Lebanese side and physically dislodge Hezbollah fighters, Hezbollah shooting positions, and to expose and destroy Hezbollah bunkers and tunnels.
Dan, Israel, the language they used, they said that they were conducting limited, localized, and targeted raids. What is the risk that it expands something beyond that?
Well, history has taught us that these things may start small, but a raid like this into another country can eventually ossify into a long-term open-ended occupation. Now, Israel has said it has no intention of doing that. It is aware of the historical precedent, and it appears that behind the scenes, the Israelis are already in touch with perhaps the Lebanese military, with the United Nations, with the United States and France, with a view to, once Hezbollah is dislodged, having some sort of workable alternative there. Perhaps the Lebanese military, perhaps with some sort of Israeli involvement and oversight. I don't think there's any intention by Israel to stay long term. Obviously, tactically, operationally, the risk is a spike in Israeli casualties. For a time now, Israel has suffered relatively fewer casualties in Gaza as it's overrun the Palestinian enclave. Now it's entering what would be, in a sense, virgin territory for its ground troops. Hezbollah has said it would welcome the opportunity to fight Israeli troops on the ground. Presumably it's set up ambushes. Presumably it's ready. It has the defender's advantage. So I think the Israelis are bracing for an escalation on their side of casualties from this. Certainly there will be Lebanese casualties as well. The question is, who remains of Lebanese civilians on the other side, given that they've been long warned by Israel, and indeed the area has seen months and months of Israeli counterstrikes that have driven away many civilians.
Dan, thank you so much for your reporting, and we are wishing you a safe journey there to the Lebanese border. That is Bloomberg's Dan Williams. Manis, let's get to some of the other top stories that are trending on the terminal this morning. CVS is conducting a strategic review of options that even includes a possible breakup. That's what sources tell us. The company has cut its 2024 earnings forecast for the past 3 quarters. It's had challenges in its drug store chains and health insurance arms. The stock now down over 20% from its peak this year.
Pfizer has raised over $3 billion from the sale of some of its stake in Haleon. The pharma giant has been selling down its stake in the UK-based maker of Panadol. Haleon was originally formed as a combination of GSK and Pfizer's consumer health units. Pfizer began trimming the stake in March. GSK sold its final shares in the company in May.
And Michael Dell, the founder and CEO of Dell, sold 10 million shares of his company's stock last Thursday. That meant he raised over $1 billion. He sold another 10 million shares in the company, worth around the same amount, earlier in the month. Dell stock has jumped over 50% this year, along with a slew of tech names benefiting from what else? AI.
Coming up on the show, we'll count you down to the data. Coming out a little bit later today with Emma Wall of Hargreaves Lansdowne.
And later in the hour, with earnings growth passing expectations, Catherine Rooney-Vera of StoneX discusses why she thinks the S&P is going to hit 58,000 by the end of the year. That's all to come on your brief. Stay with us.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today, with the election weeks away, the VP candidates are set to face off. When we fight,
you guys are going to get me all fired up again.
Trust Bloomberg for news and analysis.
So is it style or substance, or maybe both? We'll be hearing from Tim Walz and J.D. Vance in prime time.
Yeah, and the question is whether the vice presidential nominees are actually able to move the needle.
Tune in for the CBS News Vice Presidential Debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. If the economy performs as expected, then that would mean 2 more cuts this year.
That was Fed Chair Powell speaking yesterday at the National Association for Business Economics, making clear that his baseline is 25 and 25 again for the rest of the year. Joining us now is Emma Wall, Head of Investment Analysis and Research at Hargreaves Lansdown. Emma, great to speak with you this morning. So there you heard from the man himself, 50 basis points, assuming everything goes as planned. The market pulled back from that, but we're still pricing in some 65 basis points of cuts. Is this a market that still just has too big of a bias to Fed cuts?
I don't think so. I mean, it has been 2 stories that have dominated most market returns, not just in the US, but I'd say globally this year. And it's tech stocks, we can come on to those, and it's central bank policy. And what we're saying to clients is, look, you might be unsure as to whether there are those 22 lots of 25. As Powell says, don't forget it's a democratic process, so what he says doesn't mean it necessarily goes, or it could be another 50 if the economic data comes in much weaker than expected. But ultimately, this is a market where bond yields are coming down. They've already started to come down, and so we see a great opportunity here for total returns, and we're encouraging clients on both sides of the pond, actually. There are opportunities in fixed income. Lock in some great income now if that's what you need, or go on an aggregate approach, buy an index, look for a great active manager, and ride this story down, because yields are coming down, which means total returns are coming up.
I like what you put it as, Emma. Good morning. Keep it simple. Buy bonds. Larry Fink has just finished his conversation with Francine. He said this market is crazy to assume we're going to get 190 basis points of cuts by the end of next year. What would that destination look like for you with a long bond call like that?
I agree with Larry, and I also think that we've got to be, a bit mindful of where we were this time last year. Don't forget, last December, we were so bullish on bonds that we were pricing in something like 6 rate cuts for 2024, which of course have not materialized. However, at the risk of repeating myself, we do think we are at the beginning of quite a substantial bond rally. We also think this is why it's a great opportunity to go with active management, because they can really play the volatility, because we are expecting this not to be linear. We are expecting there to be volatility in this market. We've already seen a considerable amount of volatility over the last couple of months. Every time there's a piece of jobs data, non-farm payrolls, every time one of the voting members comes out and says something slightly hawkish, then you see that volatility in the market. But we think the trajectory as bond yields are coming down, therefore total returns are going up with volatility along the way. So be prepared to back a manager who can play that volatility for you.
Emma, also in your research, you write something that would have been very controversial, maybe even just 2 weeks ago. Very simple, 3 words: we like China. How much of China is predicated on continued stimulus from the PBOC, from policymakers in the region, or regardless, have they done enough that you can say, hey, I can buy this region?
Yeah, so we made a call at the beginning of the year that actually the 3 areas where we saw significant value were UK stocks, fixed income, and China. And those have taken a little longer to play out than we expected. But, China was a call at the beginning of the year, which we made, to be honest, purely on a valuation basis. We weren't making a call then about necessarily the macroeconomic picture. We do think the stimulus this week has been obviously extremely positive for the market, and we think there is continued market rally to come. What we would caveat, though, is we expect volatility along the way. And we'd also say that there's more significant work needs to be done, particularly with the way that the government considers its involvement in certain sectors and certain stocks, in particularly the tech sector. We also think that the US election is going to be really pivotal for China. But on a pure valuation basis, even on the near 30% rally that we've had since February, we do think that China equities continue to be quite compelling on a long-term view if you can stomach vol.
Yeah, it's all a question of whether you can stomach the volatility. And we've had some volatility in US, the market between Mag 7 and the rest of the market. You're very squarely in the camp of it's the other 493 that you want to buy. I just wonder what you make. The earnings in the Mag 7 are still in the high teens. Does that mean for you still hold Mag 7 but reach for breadth?
Absolutely. We're not saying take a bet against the Mag 7. We're saying this is a great opportunity to take some gains, which, if you've been in this market for a couple of years, have been significant. We're also not saying that necessarily the valuations of these stocks are wrong. But actually, if you play that through, if you say that the valuations currently in the market for the Mag 7 are correct, what you're saying is that the AI revolution truly is that. It's a revolution, which means it will benefit more than just the Mag 7. I parroted this term to my team already, but the invention of the wheel didn't just benefit cars. It was truly transformative. So therefore, if AI delivers on its promises, actually the beneficiaries will be far more widespread. And then you flip that on looking at a valuation basis, Russell and the 493. You've got some really high quality companies here that have just been out of favor. So it's a mix of maybe AI is right, maybe it is as revolutionary as the Mag 7 are leading us to believe, in which case there'll be a benefit. But on a valuation basis also, there are just some really interesting areas of the market where you could take some gains and redeploy.
Well, one sector that has certainly benefited from AI and just the fact that it's defensive is utilities, up 27% year to date. That outperforms the S&P 500. Emma, if we need to care about valuations, has that as an AI play gone too far already?
Well, I think there is some frothiness in the market. And also, I think as we have a normalized interest rate environment, you may see some of those coming off. And of course, as you get the updates from the companies, the expectation is so high that any misstep, even if there are positive numbers, if they're not what the market expects, you will see some of the valuations come off. However, I don't even think, as I said, you have to make a call about these valuations being significantly outlandish. In order to follow through that on a medium to long-term basis, there are still opportunities in the wider market. Because as I said, if that AI revolution flows through, then the beneficiaries are wider than just that extremely small, not even Mag 7, Fab 4 stocks.
Yeah, look, one theme that has come through over the past 7 days is the auto industry, whether it's here in the United States of America or indeed in Europe. But Stellantis yesterday warning, and the dealers here saying you're degrading our brands in the United States of America. How much of a warning flag is this current in the autos, global autos, and especially here in the US?
Yeah, I think actually this is one of the areas where the upcoming election is incredibly important. We've seen a lot of issues in Europe because of autos and because of the Chinese tariffs. And that tariff war that we saw at the beginning of the summer, where you see that tit for tat, has been really damaging. We saw some significant, drops in some of the European autos in June, July, as those tariffs started to come through. Now, this is a war that you need to be really careful. It plays back to the China story. If we enter into a tariff war between the US and China and Europe and China over autos, actually there are no winners. So it's definitely something that we're keeping our eye on.
Okay. Emma, thank you so much for being with us this morning. Quick jog across those markets. Emma Wall of Hargreaves Lansdowne. We'll have more on these markets and the port strike, which has just gone live across the eastern seaboard. It's Good Morning from New York.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
For the front pages, this is what's making headlines around the world. We kick it off with the New York Times. Biden says he could ask Congress to pass aid for catastrophic Helene damage. The president said that he may need to call Congress in for a special session after it did not include additional disaster relief in its spending bill. And the storm has left over 100 dead. and hundreds unaccounted for.
Next up in the Journal, Vance and Walz, they are set to take the debate stage. The two Midwest running mates are looking to boost their candidates' campaign for the presidency. It is the last scheduled debate before the election in just 5 weeks. They're going to be meeting in New York. That debate, Manus, will be hosted by CBS.
Okay, we're certainly counting down to that. What is it? Don't do any damage. I think that's the message. Just keep it on the tracks. Okay, we're leading on Bloomberg with the strike. It's shutting down the U.S. coastal ports, along with the Gulf ports. The threat is to the economy. The dock workers have walked out of every major port in the U.S. along that eastern seaboard. The affected ports have a combined capacity to handle as much as half of all U.S. trade volume. Let's get to our trades czar. It is Brendan Murray. Brendan, you say that this could unravel really quite quickly. The scale of this isn't just about wages, it's about automation, and we're looking at a potential cost to the economy of anywhere between $4.5 to $7.5 billion. How quickly does this pinch?
Yeah, I mean, look, we saw during the pandemic that a congested port in one part of the country can kind of ripple to others, but this is something we've not seen on a scale on which we've not seen in a long, long time. 36 ports between Maine and Texas, 45,000 workers walking the picket lines now. We've seen estimates anywhere from $1 billion a day to $5 billion a day. The costs are going to add up pretty quickly, and it's just a matter of time before consumers feel the pinch of both shortages of some goods and higher prices. The big question is, will the federal government step in and try to mediate some sort of solution? But at the moment, the two sides, the employers and the unions, seem pretty far apart. They traded barbs overnight, and it seems like it's going to take a lot of work to get them back to the negotiating table.
But I was going to say, what have we heard from them? What do we understand in terms of just how far apart they still are?
Well, the employer group, the Marine Alliance, said that they offered to increase the wage proposal to a 50% increase. That's over a 6-year contract. That is short of the 77% bump that the union wants. So the union rejected that overnight and the strike started at midnight.
Well, there's certainly some rich language on the board from the Brotherhood of Teamsters, isn't it, in terms of telling this administration to stay the heck, I'll paraphrase, stay the heck out of this fight. That's not the language they use. What is the possibility that Biden steps into this? There is an act, the 1947 Act, that he could use. What's the risk? What's the reward if he steps in to halt this strike?
Yeah, look, we're, 5 weeks away from the election now? So the pressure will build on the Biden administration. The president said on Sunday that he doesn't believe in using the Taft-Hartley Act. He wants to see the collective bargaining process play out. Siding with unions is going to really help the Democrats, against Donald Trump. So it's a tight rope he's got to walk here, and really no-win situation. But the pressure is coming from businesses for the president to step in and do something to stop this strike sooner rather than later, because the longer it goes on, the problems just compound and they're harder to dig out of.
Yeah, the estimates for every day that there is a strike, something like 36 days to clear that backlog. Brendan, thank you so much. That is Bloomberg's trade czar, Brendan Murray. Okay, coming up, we're going to talk about the data. We have JOLTS and PMI on deck this morning. We're going to push ahead with Catherine Rooney-Vera of StoneX. That's coming up next.
in terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manish Krani. Let's set your agenda.
A major escalation. Israeli troops move into Lebanon, launching targeted ground raids aimed at Hezbollah. A message to the market. We are not in a hurry. Fed Chair Powell reiterates data dependence mode. Up next, jolts and PMI. And an all-out strike. Dock workers walk out of every major port on the U.S. eastern seaboard and the Gulf Coast. Danny, good morning. We're not in a hurry. Did you get the message?
The markets kind of did. Yeah. We're not in a hurry. The baseline is 50 basis points of cuts. We have seen yields yesterday move higher. They moved down this morning just by about 3 basis points. We're pricing in something like 60 basis points of cuts, so still not to the 50 baseline of Powell. But man, what a quarter it has been. We're now 5 months of gains for Treasuries. That is the longest winning streak since 2010. We're now up 20% on the S&P 500 for the year. More than that, we're a little bit weaker this morning. We weakened slightly after Powell spoke. We rebounded. We're down again. Dollar is stronger this morning against most G10 currencies, notably against the euro, with the data of CPI coming in below 2%, and we're weaker versus the yen. The yen has had its strongest quarter since 2008, Manis. So that takes a breather today, but man, what a September it was, and welcome to October.
Welcome to October. The superlatives fly around, don't they? I mean, it's, 5 months in a row for the bond market. Longest stretch of gains since 2010, and the best start to stock since 1997. But when it comes to this recalibration from Chair Powell yesterday, I wonder just to what extent has he managed to regrasp some of the narrative. He couldn't have been clearer, which is, look, unless anything changes quite dramatically, calm down. You're getting 2 cuts, 50 basis points, stop betting for 75.
Yeah, and we're going to catch up with Mike McKean a little bit about this, but I thought one of the more interesting things he talked about was there's a tension with the labor market, which is cooling, and consumption and GDP data. He kind of had to talk around it because that data has been coming in strong. He essentially said, look, the labor market gives us more real-time data, and you can't look to GDP to essentially say, is there a recession? So it's very clear to Powell that one piece of data matters, and it's labor market data.
He did say that participation is high. He did also warn that jobs are not as plentiful as they were in 2019, which is almost doffing his cap to the fact that you are looking at quite a dramatic change in the unemployment rate, and that if that tips, he will tip his hat.
Duffing his cap?
To doff his cap.
I've never heard that before. Is that like a tip of the cap?
Doff your cap.
Okay, good. Phrase of the day, everybody.
Phrase of the day. Doff your cap.
So we have key economic data coming today. Traders are looking for clues on the outlook for interest rates for the rest of the year. Let's bring in Bloomberg's Michael McKee. Mike, can I just get your takeaway from Powell yesterday and your duff of the cap, I guess?
I would tip my hat to fewer rate cuts. At this point, the thing is this is going to go back and forth. Now, we don't have another Fed meeting till November 7th, and it's 2 days after the election, and there's so much in the news this morning. I mean, who knows where we're going to be, but we do get the JOLTS report today, and Jay Powell did cite that yesterday, noting that the labor market has loosened up some, but he noted there are still more jobs than available workers. 1.2% is the additional ratio for jobs to workers, and that's not expected to change today because economists have no idea really where JOLTS is going to come in, and they're betting that it's going to be exactly the same as it was in August, 7,673,000. So that's kind of a wild guess, I think, but we've had trouble with JOLTS lately. Then we get ISM, you're talking about GDP, we get ISM. It has been in recession since 2022, below the 50 mark, except for 1 month where it popped up. And we're not expecting a change there either. ISM expected it at 47.5, up a little bit from 47.2. So there seems to be some sort of manufacturing recession going on that hasn't dragged the overall economy down yet.
No, it hasn't. And we know that the immigration story is the one that's been used to discuss the unemployment numbers. But when it comes to the data, Powell certainly in the camp of, look, if I see something more aggressive, we will move. And then you've got Larry Fink on the tape this morning talking about a no landing scenario versus a soft landing scenario. So in terms of the data, what do we need to see?
Well, Powell basically says we need to see what we predicted at the last meeting, which is 4.2% unemployment, 4.4% by the end of the year unemployment, and growth of a little more than 2%. And right now we're coming in well ahead of that. The Atlanta Fed GDP says 3.1%. But if we get that, here's what Jay Powell said about what the Fed's going to do.
This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. The bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data. But ultimately, that's what the baseline is. If the economy performs as expected, then that would mean 2 more cuts this year.
In other words, to use another phrase, Danny, hold your horses, according to the Fed chairman. Although, interestingly, the Fed funds futures collapsed a little bit yesterday when he said that, but they're pretty much back to where they were, 1.4 cuts before he spoke. So the market is going to keep pushing, and the Fed will keep pushing back, and we'll see what the data say.
Yeah, perhaps Deutsche Bank were a little bit out of sync when they said it was a conditional pushback, but he didn't necessarily win the war. Mike, thank you very much. That's Mike McKee with the synopsis of what Jay Powell had to say to us yesterday. Catherine Rooney was listening in. Catherine Rooney-Vera, Chief Market Strategist over at StoneX Financial. Good to have you with us. So, you know, the bond market was listening more to Powell than the equity market was listening. How much of a recalibration do you think he really achieved yesterday, Catherine? Good morning.
Hi, good morning. Well, at least he pushed back on expectations that there would be pretty aggressive cuts, and I think that was becoming more of the consensus view that Powell was going to launch an additional 100 to 200 basis point in cuts in the next 12 months. And the truth is, if the economy continues to grow markedly above potential, that's not going to happen. That's my viewpoint. The Atlanta Nowcast published their expectation, or their forecast is for the third quarter of this year, and that came at 3.1%. So that to me doesn't sound like a soft landing. It sounds more like a no landing. And if the U.S. economy continues to operate so much above potential, and we have additional industrial policy protectionism, I think that could as well be inflationary, causing a real problem for the Fed. And I didn't even mention the conflagration that we've seen in the Middle East and the robustness of the stimuli out of China, all of which, of course, is positive for commodities and thereby positive for inflationary pressures going into 2025.
Catherine, that sounds like a good reason to be a little bit bearish risk, but you're not. You say the risk for the S&P 500 is to the upside. Why?
Well, I think the Fed is going to cut another 2 times, probably this year, 25 basis points each, not at the 50 pace that a lot of people are expecting, rightly so, because the Fed launched with a 50 basis point cut. But I do think that the momentum is to the upside. This is the best electoral outcome for the markets in the lead up to an election that we've seen in a really long time. I think that this election, if we get a division in Congress, the Senate and the House going to different powers, different hands, it really almost doesn't matter to the markets who takes the presidency, because it limits the more extreme policy making ideas. So I do think that the elections, unless we get which is a real possibility, unless we do not get a clear victor on the night of November 5th, the markets drop. In my opinion, Danny, that's a buy.
Okay, so you want to buy all dips if we go into perhaps a contested election. But the one thing that you did put there is a no landing on the table with tariffs equals inflation and some geopolitical risk. How fat a tail risk is inflation then for you going into 2025? Is that where you lean into when you buy the dip?
Under a no landing scenario, I think the risk of reacceleration in inflation is very real. And that is why coming into this year, I've been recommending gold. Gold's done very well. I think that you want to be positioned in some amount in cash. I think utilities was my top pick this year. I think and it's done extraordinarily well. Going into next year, I think the pick is going to be healthcare. I'm saying protect your earnings, protect your gains, because while there is near-term momentum, there are inherent underpriced and, in my opinion, very large risks that need to be accounted for in portfolio positioning. And you can buy, a portfolio manager can buy pretty relatively cheap puts to protect those positions on the equity front. And I think, as one of your guests prior to me talked about, fixed income is looking really attractive. And I would even look at mortgage-backed securities in that light.
When it comes to healthcare, it has underperformed the S&P this year. To your point, 13% year gain, the S&P something like 21%. Why hasn't it rallied with the rest of the defensive sectors? Why hasn't it kept pace with something like utilities, which, as you say, you were spot on with that call?
Yeah, thank you. Utilities was a big call for us this year, and I think that is an AI play, whereas healthcare is not. So that was my call going into this year, and it seems to have played out now as consensus, which is, of course, that AI sucks quite a bit of energy. Also, industrial real estate. These are two things that I think, as one of your prior guests also mentioned, all boats rise with this AI revolution. But specifically, second order effects, I think, Danny, are in utilities and industrial real estate. Utilities is largely played out, so I'm looking for the next underpriced sector. And I like the fact that it's defensive. So I think that going into next year, it makes sense to me.
Catherine, it is always a real pleasure speaking with you. Thanks for joining us so early this morning. Catherine Rooney-Vera of StoneX Financial. Coming up, VPs go head-to-head. We're going to preview the first debate and last between J.D. Vance and Tim Walz. That's coming up next in your brief.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that, other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The United States will continue to work with our partners in the region and around the world to advance a diplomatic resolution that provides real security to Israel, to Lebanon, and allows citizens on both sides of the border to return to their homes. Diplomacy remains the best and only path to achieving greater stability in the Middle East.
Secretary of State there, Antony Blinken, speaking yesterday before the escalation in the Middle East overnight, where the Israeli troops began their ground raids into Lebanon. And this morning, the Israel Defense Forces say millions of Israelis are in shelter following projectile launches from Lebanon targeting central Israel. This is coming as the U.S. says it's deploying a few more thousand troops to the region to defend Israel. The Defense Secretary, Lloyd Austin, posting on X after speaking with Israeli counterparts, saying, "We agreed on the necessity of dismantling the attack infrastructure along the border to ensure the Lebanese Hezbollah cannot conduct October 7-style attacks on Israel's northern communities." David Gura is with us this morning. David, this is the beginning of a new escalation into Lebanon. The debate is whether this is a short, sharp incursion and withdrawal to build a bigger buffer. But when you see more troops being deployed, and Lloyd Austin talks about the importance of ultimately pivoting from a military operation to diplomacy, diplomacy looks very far away at the moment.
Yeah, so the word targeting, I think, is doing a lot of work here this morning as we look at what's happening, and Israel saying that these are targeted attacks in Lebanon. But you're right to mention that over these last many months, the United States has been emphatic that diplomacy is the only solution here, calling for a ceasefire. Even over this weekend, there was this shuttle diplomacy happening between the U.S. and Israel, kind of urging them not to launch these kinds of attacks, and lo, Israel did. So I think the U.S. is sort of waiting with bated breath here, as you say, they're bringing more military might to bear in the Middle East. Worried, I think, about contagion and fallout in the region. And at this point, it's still difficult to sort of see the magnitude of what's happening here. We've seen evidence of these attacks. And of course, there have been aerial bombardments of Beirut as well. The first time we've seen that in more than a year. So I think the U.S. watching here, obviously with some frustration over the fact that what influence they might have had in the past doesn't seem to be coming to bear here this time around.
If we can bring it back closer to home, we're going to have the first and only vice presidential debate, and maybe it has more importance because we just haven't had as many debates with the ticket as it currently stands. But what are the stakes for this?
So historically, when you have a debate of vice presidential candidates, the objective is to not do anything that will ruffle feathers or kind of make them stand out. I think that what makes this one unique is that, unlike in the past, where the VP debate has been kind of sandwiched between presidential debates, this is it for the vice presidential nominees. It's also it for the presidential nominees as well. There's very little hope that there's going to be another presidential debate before the election. So I think that it's a high-pressure moment for both of these candidates. A lot of Americans haven't seen them individually or together, haven't seen the debate on a national stage before. Both of them taking this very seriously, having done mock debates over these last couple of weeks. So I think a moment when they kind of step onto the national stage and we better get a better sense of just sort of how they would comport themselves on that.
I think it's going to be an interesting one. You just read the New York Times, they're talking about Vance preparing with what he calls a murder board prep sessions. In other words, rat-tat-tat, real rapid-fire questions versus Waltz. We'll see how that plays out, and we'll have full coverage of that. Both the campaigns responding to Hurricane Helene. You had Vice President, of course, at FEMA, and then you had Trump in Georgia. And again, politicizing to a certain extent what is a horrendous situation in some of these southern swing states.
And President Biden saying he's going to do an aerial flyover of Asheville, North Carolina on Wednesday of this week. I'm from North Carolina and have friends who live in the western part of the state, and as they describe it to me, the devastation is kind of unfathomable. And the complicating factor is a lot of the roads that would lead into a place like Asheville, Buncombe County in western North Carolina, are simply washed out. So people are stuck. with feet of water around them, very little infrastructure, no power, no communication. So you're right, Manus. I think that it's a very dire situation, and politics has to play delicately. We had former President Trump going to Georgia yesterday, attracting some criticism for going there at a moment when all of these emergency responders are trying to work and do as much as they can. Obviously, the visit of a former or current president complicates that. So when you look at what President Biden has proposed here, it is not to go on the ground yet, to do that in time to make it to Georgia and other states as well in the coming days, but to fly over at this point.
There's some just extremely delicate situations that the Biden administration has to deal with an eye on the election. I mean, the port strike that happened at midnight certainly feels like one of those. Is there any sense that the Biden administration will more forcefully step in and do something to try to resolve it for fear of those headlines heading into the holiday season that just don't look good?
Well, President Biden, as you know, has said that he won't do that, and he's somebody who's closely aligned himself with unions throughout his entire political career. He's saying he's going to do that as well, but you're right, this is a crucible or a moment when this isn't great for them, and they've had kind of difficulties with unions over these last many months. Vice President Harris as well. Obviously, she wanted the endorsement of the Teamsters. She didn't get them. But I think both candidates acutely aware of what effect this could have on the economy, and these projections of it having $3 to $4 billion worth of damage to the economy is just huge and nothing that they want here 5 weeks before the election.
Right, and as Manus put it, I'll abbreviate the Teamsters president saying the U.S. government should stay the F out of the negotiations.
She's braver than I am. I didn't actually go for the F, but Danny went full blown.
Say the word.
No.
Say the word. David, thank you so much. That's Bloomberg's David Gurr. We really appreciate it. And tune in to special coverage tonight of the debate on Bloomberg TV starting at 8 p.m. Eastern. Okay, let's turn now to this equity market, a stock we're keeping our eye on, CVS. Shares are climbing in the pre-market trade this morning, up 2.2%. It's said to be conducting a strategic review of options, including a possible breakup. All of that, according to Bloomberg sources. For more on this, let's bring in Bloomberg's Dasha Afanasieva. Dasha, just what is potentially CVS proposing here?
So CVS has 3 units. You've got your benefits arm, which includes that $70 billion acquisition of Aetna Insurance it did like 6 years ago. It's got a business that does provide services in clinics and in homes. These are healthcare services. And finally, it's got its pharmacy services and diagnostics and vaccines, as well as prescriptions, of course, and things like vitamins, etc. They're roughly pretty much evenly split in terms of revenue, but each one of those units is struggling to either grow sales or to grow operating profit, or both. There's increased scrutiny of drugs and healthcare prices, and costs have actually gone up since the pandemic because there's this backlog of treatments. The company cut its profit outlook for the year in May, and now is looking at these options reportedly.
Well, look, they've already taken some remedial action, haven't they, in terms of trying to fix some of the parts of the business. What's working or what's not working, as the case may be?
Yes, so they got rid of their head of the benefits unit, and Chief Executive Karen Lynch has actually stepped in to run that together with her CFO in the interim whilst they look for someone else. They've also got a multi-year plan to make productivity savings to the tune of $2 billion. But the thing is, just as recently as last year, they doubled down on this healthcare integration by making two decent-sized acquisitions. You had a chain of clinics treating elderly patients called Oak Tree that were bought for $11 billion, including debt, and also Signify Health, which was around $8 billion just last year. And it does seem like that broader healthcare integration narrative isn't really working. So it sort of makes sense that bankers are pitching the alternative with sort of a breakup. Time will tell if the market will actually respond to that kind of breakup positively.
Okay, well, we're up 2.8% at the moment on the stock, and healthcare and the logistics and regulation around that are going to be a hot topic in this election here in the United States. Dasha, thank you very much. Dasha Afanasieva on the very latest with CVS. Coming up on the show, economic data ahead for you on the slate, a vice presidential candidate debate for you on stage. Context matters. This is Bloomberg.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It's Bloomberg Brief. I'm Manus Cranny in New York. Your day ahead looks a little bit like this. S&P PMIs hit the tape at 9:45 Eastern. ISM manufacturing and JOLTS come at 10 a.m. We're going to hear more Fed speak. We've got Bostic, Cook, Barkin, and Collins all starting off at 11 a.m. And then we count down to Governor Tim Walz and Senator J.D. Vance. They square off in the vice presidential debate. That's at 9 p.m. this evening. You can watch it right here on Bloomberg Television. Some movies for you. This is what we got. Zim Integrated Shipping. The shippers lower as the U.S. ports shut for the strike. Disney falling. Raymond James downgrades the stock. They say that there is weakness in the parks business. And Atlassian gains after Raymond James upgrades the stock on cloud optimism. So we've got a nice bid there for Atlassian at the end. This is state of play on the equity markets. Look, you start the fourth quarter after having put on $2.5 trillion worth in the third quarter. The message from our guest this morning has been very, very clear. You want to be long of risk and long of bonds. That was the message from Emma Waller-Hargreaves Lansdowne. It's very simple. Keep it simple. Buy bonds, buy duration. Yields fall ever so slightly this morning. We're counting down to JOLTS. There was a message from Jay Powell. This committee is not in a hurry. So there's some conditional pushback from the chair, but did he achieve much? No, because the market's still pushing for further rate cuts. Larry Fink says it's a no landing. Larry Fink says the forwards rates market is quite frankly crazy at 190 basis points of cuts by the end of next year. Yields dip. Danny's off to the port. We'll see you again tomorrow morning. We'll take you into day 2 of the port closures across the eastern seaboard and the Gulf. That's it for Bloomberg Brief. Surveillance is up next with Jonathan, Lisa, and Anne-Marie from New York. Good morning.
To succeed in Wall Street, what skills do you need? You need to be somebody who claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings, they came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
We're in the midst of a global easing cycle, but a fast-moving Fed can open the door for that to be faster.
We do have a great soft landing scenario right now.
If you were to get a reacceleration in inflation, I think the Fed goes on hold.
Our base case is one more 50 and then back to 25s, but honestly, everything's on the table for this Fed.
The impact of the eases won't be known until the middle of next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Closing out Q3, welcome to Q4. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, following 5 straight months of gains, 4 consecutive quarterly gains on the S&P 500. Your scores as we kick off the final quarter of 2024 look like this. Equity futures on the S&P 500 down by about 1/10 of 1%. The Nasdaq up by a single 1/10 of 1%. The Russell is down 2. Our top story this morning, it's going to be market related at some point if this continues. Dock workers walking out of every major port on the U.S. Eastern Gulf Coast for the first time since 1977.
Just to put this into perspective, this potentially could affect half of all of U.S. trade volume. This is not insignificant. JP Morgan estimating that the U.S. economic impact could be somewhere from $3.8 billion to $4.5 billion a day. We're talking about a pretty massive impact should it continue that carries exponential risks the longer it goes on.
Pretty powerful message coming from union leaders. We're prepared to fight for as long as necessary to stay out on strike for whatever period of time it takes.
2 sticking points, Jonathan, this comes down to. One is wages, and the other is the language around automation. We do know that the past 24 hours, there have been this back and forth regarding these negotiations, and this is what the United States Maritime Alliance came out with a press release. They said that their offer would increase wages by nearly 50%, though they did say it would retain the current language around automation. We cannot overstate how difficult this moment is for the Biden White House and, by proximity, the current Democratic candidate, the Vice President, Kamala Harris. This is really going to test them. They want to be seen that they're the sign of the unions. At the same time, they don't want chaos at the ports, and they definitely don't want reacceleration of inflation.
This has the very real potential to be a political nightmare over the next 4 weeks.
On every level, you're talking about the question of being union-friendly, while also being technologically forward, by also dealing with an economy that potentially could be vulnerable. Think about how Federal Reserve deals with data that might be muddied by as much as 70,000 jobs. You might see 70,000 jobs subtracted from the total because of some of the strikes that we're seeing. So if you're Jay Powell, do you cut? I mean, not to bring this down to 25 or 50, and that's the ultimate question, but ultimately, how do you work with data that gets messier and messier?
We do have the U.S. Chamber of Commerce coming out. You're saying this is very difficult for the administration right now, writing a letter basically to them saying it's unconscionable to allow a contract dispute to inflict such this pain on the economy. Then you go to what the Teamsters is saying this morning. I'm not going to quote him on air, Sean O'Brien, because he uses an explicit word, but he basically says the U.S. government should stay the explicit out of this fight and allow the union workers to withhold their labor for the wages.
Too early for the F-bomb. Plenty of coverage of this story throughout this morning. Look out for that. Equity futures on the S&P 500 negative here by 0.1%. In the bond market, we're shaping up as follows. A 10-year Treasury in America yields are lower by about 3 or 4 basis points. The 10-year 3.7448. Monthly gains in the equity market, monthly gains in the bond market, yields lower.
Jim Reed of Deutsche Bank put out this statistic, and I thought it was pretty incredible, that the S&P has now posted its strongest year-to-date advance of the 21st century so far in the third quarter, through the third quarter, having advanced more than 20% so far this year. We haven't seen the downdrafts, and it has been a grind through all the pessimism, the wall of worry, people who cared about the auctions, people who cared about the deficit. They were pushed aside. Instead, the bulls reigned supreme up until now.
I liked how you didn't go people who cared about the auctions. It was people who cared about the auctions. Coming up this hour, Peter Cheer of Academy Securities with Powell saying the Fed will take its time cutting interest rates. Republican Senator Bill Hagerty on the aftermath of Hurricane Helene. And we'll speak to Andrew Holmhorst of Citi on the economic impact of port strikes on the East Coast. We begin this hour with stocks kicking off Q4 on pause as Fed Chair Jay Powell signals he's in no hurry to cut interest rates. Peter Cheer of Academy writing, there is this lingering concern for me that the post-FOMC surge was strange and it isn't getting any material follow-through. The discussion is clearly headed towards the neutral rate. The good thing about that is we all know it's a number somewhere between 0 and 5%. A very sarcastic Peter Cheer joins us now for more. Pete, we'll get to the neutral rate debate in just a moment. I want to start with that strange, that word strange. What was strange about the post-FOMC surge in this equity market?
You know, after the FOMC on that Wednesday, market sold off a little bit. They gave up some earlier gains. The entire surge occurred overnight, right? We won't up high. We actually finished slightly lower that Thursday, Friday. Last week, you keep bouncing around and talking to a lot of technical experts. Briefly, it looks like we're going to break to higher highs by significant amounts. Then all of a sudden, intraday, it turns. Even yesterday, right? We were doing okay. Powell then came out and basically said, we're going to be slow to cut. Market sold off. We rallied strongly in the end. And right now, markets don't seem to know what to do with all the news going on.
Pete, we're going to be slow because he thinks this economy is better than he thought it was. That was the message I got from that interview just yesterday. On top of that, we've got some easing out of China. And Pete, there's a lot of bulls getting very excited, very bullish. Are you saying they shouldn't be?
So I think there's two separate stories here. One is, in terms of our own economy, I actually think it's going to be fine. I would not be surprised to see that this week we actually get upward revisions to to non-farm payrolls, which has been, the bane of kind of everyone's existence, and a decent number. I don't know how the market will react to that, but I think we have to price out the Fed a little bit. So I think that provides from the U.S. weakness. I think ultimately the Chinese stimulus is going to help the Chinese companies, maybe the Chinese economy. It's not going to translate very well to U.S. companies. So I think the selling pressure on U.S. versus buying in China, which has been ongoing off and on for the last 3 or 4 days, will actually continue and accelerate after that kind of brief parabolic move.
All right, there's a lot to unpack here. I just want to go to this idea that you're saying with an upward revision to non-farm payrolls. What do you think the market response will be to ultimately what should be treated as good news?
So since I spent most of the last year arguing that payrolls were overstated, I was not alone in that. We kept pointing out issues with the birth-death model, all sorts of things. Seasonalities to me have been a big issue, that we add too many jobs in January, February. We take too many jobs away in the summer due to misplaced seasonals, both on demographic shifts and including COVID. So now all of a sudden, everyone's talking about downward revisions, how weak payroll has been. Even Powell mentioned it during his press conference about they potentially are overstated. So to me, it would be a big shock to the market if we get a decent number and actually upward revisions. Break that trend. I think the market sells off very hard on bonds. I think we go to 4% very quickly on 10s if we get something like that on Friday.
And the read through to stocks?
Yeah, I think stocks have been benefiting from this whole view that rates are going lower, that they're cutting, that the neutral rate's somewhere below 3%, and we're going to get there in July. I think that would derail it. Again, I'm talking about a number maybe 130 to 160 on jobs, so not great, not like, ooh, this is so good that stocks have to rally. something that's like, ooh, this takes the Fed off the table, and that's what we relied on for the last 2 weeks is the Fed. So that's why we see a pullback in stocks.
We have been inundated by bigger geopolitical stories and domestic stories that should move markets that absolutely don't. And we have been befuddled all year about a number of stories like that. Now we have the biggest dock worker strike since 1977 that could potentially affect half of U.S. trade. We're dealing with the aftermath of one of the most catastrophic in terms of damage storms in the United States. Will any of these incidents affect your view of what's going on, or are we going to ignore it like everything else?
You know, you can, I think, add that Israel started their ground attack against Hezbollah yesterday. So you have all these major factors. So far, markets are not responding. I think on the U.S., we've dealt with hurricanes before. It's awful. We will get through it. It's super painful for the people there. FEMA and them will get their act together. You know, we saw brief disruptions when Houston had hurricanes a few years ago. I think the market has learned, okay, this is awful for the people involved, but it tends not to have a protracted effect on the economy, so we're not going to move too much on that. The dock workers, I think everyone's waiting to see, does the government respond? Do they take some action to force the strike to end? Where does this all play out? So again, I think that will take time to grow. And then what's going on in the Middle East, I continue to believe that what we are seeing is Israel escalating to de-escalate, and that's why we're not seeing a big response from that, because Iran has shown itself to be fairly weak. The proxies have to be getting scared. So this escalation by Israel is likely still pushing towards de-escalation, where we realize that the proxies are probably going to run scared and calm things down over time.
Peter, you put out a new note about Israel, and I know you have a number of generals around you at Academy Securities. Are they concerned, though, that we are closer at this point to a wider escalation in the region, bringing in more proxy groups, given the fact that in the past few days we've had Israel now not just fighting Gaza with Hamas in Gaza and Lebanon in the north with Hezbollah, but also striking the Houthis?
You know, we see that as a risk, but I think from a pure military standpoint, they want to take advantage of the hesitancy that's going to be in the proxy groups, right? They had the pager attack followed by the walkie-talkie attack. Then they went after groups in personal meetings, right? So really, it's Bullah's in disarray. But the belief would be that every proxy is wondering what has been tapped into, how secure are they, are their lives safe? So I think there's a window of opportunity for them to press hard against the proxies. And so far, Iran has kind of been impotent, right? There have been plenty of excuses for Iran to reattack. I'm sticking with the group of generals. Not all of them say this, but a core group do say that Iran really did try and damage Israel with that 1,000 missile, drone, rocket attack. It failed. They cannot, have a second such failed attack. So I think our generals as a whole view that this is the right steps from a pure military standpoint from Israel to take advantage of this, dislocation. They will push it. This is unfortunately, again, not going to be quick. It's not going to take days. They're going to have to go through houses searching for weapons. So I think this is going to be in the headline for the next couple of weeks. But it is, from a military standpoint, the right thing to take advantage of this and keep the proxies on their heel. I think a couple of generals, even in our note, mentioned that deterrence is at best an awkward thing. It's very hard to manage deterrence without actually willing to use that force. And I think that's where we're at right now with Israel.
The U.S. will be sending more troops to the Middle East. Do your generals think that the U.S. have set a level of deterrence?
I think it's very supportive to the region. It is going to give yet further pause for Iran to attack, right? Without the carrier groups, maybe Iran would get more, aggressive in their response. With those carrier groups, I think Iran is very, very reluctant and quite frankly scared to involve the U.S. directly. So that helps tamp Iran down, allowing Israel to deal with the proxies.
Pete, I just want to throw in China just before we go, then I've got to get some breaking news on Boeing. How to play this China story, Pete? What's the best way of playing it? Because a lot of people have been piling in the last week.
So I think we went out yesterday saying we recommend taking a little bit of profits because it's been a huge gain. China's been a semi-core position for us off and on this year. We try and time it. I do think you want to start buying back. I think you get FXI, which I think is around 32 right now, which is a decent proxy for China. That gets up to 40. K-Web, which is more their internet and the names that people recognize, that did better, faster. This is going to be a slow thing. And I think just like the whatever it takes moments, we had this huge short covering surge. Everyone's like, oh, phew, now it's over. We can get back to hating on Chinese stocks. I think it's going to sink in over the coming weeks and months that this is good for China and Chinese stocks. You're going to see their consumers spend on domestic brands. That's going to grow. And to me, unfortunately, this just gives China buys time to do their made by China strategy, which is to push their brands more aggressively globally. So I'm keeping an eye on that. But I think the beneficiaries are the Chinese stock market. Yesterday's sell-off was kind of normal after a parabolic move, but I think we're going to see a steady grind higher from here.
It's something you've said repeatedly for most of the last year. Pete, thank you, sir. Peter Chair of Academy. Here's that news on Boeing. Their stock in the pre-market down by more than 3%. The reporting from the team here at Bloomberg that Boeing is said to be considering raising at least $10 billion by selling new stock, in line with the capital raise floated by Sheila Kahyaoglu of Jefferies a number of weeks ago, that 10 billion number.
Well, they're hemorrhaging cash, right? They're losing something like they've got a negative cash flow of more than $3 billion a quarter. The company is said to be working with advisors to explore its options, something a company never wants to have to say. They also are discussing raising this equity, maybe not right now, but down the road, because they want to understand what the financial implications are from the fact that 33,000 of its workers are still on strike. It's just a company with a lot of question marks around it, a lot of hair, and they need money, and that's becoming apparent.
The latest reporting from the team here at Bloomberg, Boeing is down by about 3%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Hurricane Helene has now killed more than 100 people across 6 states in the U.S. South. Most of the victims died due to flooding. According to AccuWeather, the economic loss from the storm could be between $145 to $160 billion, making it one of the most destructive storms on record. President Joe Biden says he'll tour North Carolina by air tomorrow morning. Meanwhile, the Wall Street Journal is reporting that PepsiCo is in advanced talks to buy Siete Foods for over $1 billion. Siete, which is privately owned, is known for its Mexican-inspired products, including grain-free tortilla chips. The report says a deal could be announced soon, at a time when Siete is said to be drawing takeover interest from private equity firms as well. And President Jimmy Carter is celebrating his 100th birthday today, making him the first American president to live a full century. Carter served one presidential term from 1977 to 1981, and then worked for more than 4 decades, leading the Carter Center, which he co-founded with his wife, Rosalind. Carter has been living in the last 19 months in hospice care in his hometown of Plains, Georgia. And last month, his grandson said the former president said he was trying to make it to vote for Kamala Harris. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, dock workers go on strike.
Just today had another convening that my colleagues at DOT brought together with about 60 different players across logistics and supply chains. But certainly the best thing that could happen is for the parties to quickly come to terms.
We'll talk about why that's not happening anytime soon. That conversation up next from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities right now on the S&P 500, negative by 0.06%. I can't believe I'm saying this already this morning. Q4. Where did Q4 come from in 2024?
I mean, the funny thing about it is we've been through about 25 narratives between now and Q4. We've been through about 25 different election cycles. We've been through about 27 different geopolitical threats. And now here we are. We're staring down the barrel of the most volatile month, just sort of shell-shocked, waiting for what can possibly happen next.
We've had a hard landing, we've had a soft landing, we've had a no landing. I'm not sure what we're back to, but we've had 5 months of gains on both the equity market and the bond market. Under surveillance this morning, dock workers go on strike.
Just today had another convening that my colleagues at DOT brought together with about 60 different players across logistics and supply chains to make sure that we're mapping everything and anything that needs to happen in terms of adjustments or flexibilities across road, rail, and different ports across the United States. But certainly the best thing that could happen is for the parties to quickly come to terms.
So here's the latest. Every major port on the U.S. East and Gulf Coast screeching to a halt as dock workers there go on strike for the first time since 1977. Union leader Harold Deckard saying we are prepared to fight as long as necessary to stay out on strike for whatever period of time it takes. The walkout threatening to ripple through the economy and reshape the final weeks of the presidential election. With us here in New York City, Bloomberg's David Gura. David, let's start here. How wide is the spread between the dock workers, the union leaders, and the companies?
It's been wide for some time, many months now, and so there was this overture last night. The group representing the docks themselves, ports themselves, saying that they've reached out, offering more money to the workers, but very late in the game. Obviously made no impact before midnight when this all came underway. So it seems pretty wide still, although maybe there's more momentum here to talk as this picks up speed, but a difficult circumstance, and one I think as the days go on, we're going to see sort of the economic impact, and that's going to be pretty devastating.
We saw from the employer coming out and talking about this 50% or close to 50% wage increase. The one thing that they seem not willing to change is the language on automation. How much is that becoming really the cudgel?
A huge issue, and you go back and see what former President Trump has said about this. He seems sympathetic to the argument that they were making about this, the workers are making about this before. It's definitely a huge cudgel here and something that's going to be a big issue going forward. Yes, the money matters, but I think it's also this recognition of the fact that the industry itself is changing. How do you forestall those changes if they're going to lead to layoffs or contraction in the labor force going forward? So it is that language, I think, is going to be key here as they go back to the negotiating table.
So the politics are really interesting because this is one union that hasn't made a decision on who they're going to endorse. Although in 2020, they did go for Biden.
Yes, and a smaller union, obviously, than the Teamsters, and the head of the Teamsters, Shawna Brown, out with a salty statement this morning saying that the government should, I'll just say, stay out of these conversations. I'll leave the expletive out of it. But, I think that that's the debate that's going to unfold here, too, is what role, if any, does the administration play? And Joe Biden saying that he's going to stay out by principle. But I think it's going to be more difficult for them to do that as this goes on. And we've seen kind of the back channel conversations that have been happening among administration officials and the union and the docs themselves.
So where do those conversations stand today?
I think over the weekend we saw the Commerce Department and economic advisors reaching out to the ports to have those conversations. Right now, I think there's probably a greater urgency to having them, probably trying to get both of these sides to come back to the table. But now I think everyone's still at this point just kind of looking at what's happening here, kind of trying to figure out how long this is likely to last.
How much do you have a sense that this timing isn't a coincidence? That this timing is actually very much in tandem with the election cycle to try to put pressure on this administration to grease the wheels for a better deal for the union?
Look, I don't want to be conspiratorial, but it ain't good. The timing isn't good, like 5 weeks out till the election. I think that it's added pressure for them to come to the table and come to kind of an agreement now. Obviously, it's in neither candidate's advantage or the greater economy and population's advantage for this to be happening now as we push ahead to the holidays, as people are going to buy gifts, food, all kinds of items for the holidays. But yeah, I think it's I don't want to ascribe it to that, but it is certainly a pressure point.
What I'm getting at is we've been asking on this show, how much is this happening now because workers have more leverage versus sort of the last gasps of leverage before a shift both in the economic as well as the temperature in the White House? And this question of trying to get ahead of that and using that before some real shifts in technology as well as in the political sphere. I'm just wondering how much this is an effort to get the White House to intervene on the part of the union to try to get this deal through before that window has closed?
Look, I think it's a good question. Over these last many years, we've seen the power of unions get bigger and bigger. And you look at the strike, there hasn't been a strike like this in many decades among dock workers on the East Coast where there's been this kind of shutdown. So I think that there's a broad sense among labor that they have more power now. There have been a string of successes, whether it's auto workers or others. And I think that they feel like, I think workers feel like they have more influence here than they have in the last many years.
Certainly a great opportunity for them, some real leverage for the next 4 weeks or so. David, before you go, in a moment we'll catch up with Senator Haggerty of Tennessee. East Tennessee has been a disaster zone over the last few days. I know the west of your state, North Carolina, has as well. How bad are things on the ground?
So I've reached out to a few friends of mine who live out there, two of whom are doctors, and one described to me leaving her house with no power or communications, hiking to the hospital to work there, and both of them telling me that it's hard to fathom the level of devastation that there is in that state. And I think that the real issue is just being able to access these communities. And so we heard from the governor of North Carolina yesterday, from the president from FEMA as well. A lot of supplies are being brought in aerially. President Biden's going to go there Wednesday to fly over it as well. But the flooding is intense. No communication, no power in a lot of these places, and just an inability to get in and out of these communities, both in eastern Tennessee and western North Carolina. So it's, I've seen the comparison drawn to Katrina. Look, it's a smaller population, but it's remote, and there's a lot of poverty there. And I think that the devastation we're just beginning to kind of come to grips with and fathom.
Shocking pictures coming out of these states over the last few days.
Yeah, more than 100 people have been declared dead, and there are a number of people missing. Expectations for $160 billion being necessary to rebuild some of the devastation. A real question of what this means for which areas are most prone to hurricanes, given the fact that it is inland, it is away from some of the coastlines, but really flooding, a storm that just sits there and keeps dropping rain, presents some new issues that people have to really think about.
And how many people are stranded? Because in North Carolina, I looked at what some of the local officials are putting out, and they're saying you can't call 911. It's inexistent. We don't have the phone lines working, so you have to actually trek to your local emergency services to try to get for help. So there's still so many questions, so many unknowns right now.
Well, one question, did they recover in time for the election? What does this look like? What does voting look like in these states over the next month or so?
Early voting has begun in some places. I think they're trying to take steps now to figure that out. But, you know, there's a lot of kind of political innuendo being thrown around about who's being helped and whatnot. And
sure,
we'll see what is true about that in the coming days. But certainly a compounding issue.
David, thank you for your time this morning. Appreciate it. Bloomberg's David Gura there on the strikes on ports across the East Coast and across to the Gulf Coast and the disaster zones across this country. I think we can call them that, Lisa, over the last few days.
I don't think there's any other way to describe it. People have been knocked out of their homes, no reception, and there's a real kind of new fear that people hadn't felt before, especially in areas that had newly become popular like Asheville. So a real question here about what the future brings, and then, of course, the political implications heading into November.
We'll get to some of those implications in just a moment. Up next on the program, we'll catch up with Republican Senator Bill Haggerty of Tennessee as the Southeast struggles to recover from Hurricane Helene. That conversation just around the corner. Equity futures on the S&P 500 just a little bit softer. We're essentially unchanged on the S&P at negative 0.04%. A bit of a rally in the bond market. Yields lower by close to 4 basis points. Your 10-year 374.29 from New York. This is Bloomberg.
many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Five months of gains on the S&P 500 kicking off October and Q4. We're negative by 0.02%. On the Nasdaq 100, we're positive by 0.1%. On the Russell, just a little bit softer. The Russell on the quarter in Q3 up by close to 9%. Stunning rally for the small caps.
That was a quarter that we just had that really was marked by the outperformance of the broadening out of the equal weight of the Russell 2000, and it came in tandem with yields heading lower for a fifth consecutive month. A real question of whether that can continue.
Well, let's get to that bond market move. 2-year, 10-year dropping for 5 consecutive months. Moves we haven't seen on the 10-year going all the way back to 2010, which I was very surprised by. Yield to lower by 4 basis points on a 10-year this morning, 374.29. The 2-year pretty anchored at the moment here, Lisa, 361.25, following those comments from Chairman Powell yesterday afternoon.
Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance, but we are not on any preset course. That's me channeling Jay Powell. That was his comment yesterday. We also heard from Goolsbee and Bostic and Bowman yesterday, and it was all over the place. Basically, Bostic coming out saying he would support a 50 basis point move should the data warrant it. Bowman continuing to be the one herald of potential inflation. So she was the resident hawk, and Goolsbee being like, we need to cut aggressively, let's just get it down. So, you know, basically, where does this leave us? This has really changed the scenario all that much.
We wondered whether we'd get a sprinkle of Goolsbee from Chairman Powell. I think that's where the bias of the market was. Perhaps he'd come out and say we're a long way from neutral, suggested that maybe the next few moves were the easier moves, and I didn't hear that at all. In fact, I heard a chairman that was much more confident about underlying growth in America following recent data.
Which is the reason why you saw a bit of a sell-off in Treasuries, yields a bit higher on the heels of this, but suddenly people thinking, wait a second here, he's not super dove, he's something that's a little bit more balanced. And does this mean that the Larry Finks of the world of BlackRock are correct, that basically the market's gotten way ahead of itself with how many rate cuts it's priced in and needs to temper that? How much is that a risk and how much does that matter heading into non-farm payrolls for the likes of risk assets, given the fact that good news ultimately, according to Mike Wilson of Morgan Stanley, should be good news?
Payrolls just around the corner. I want to finish on foreign exchange. Euro dollar negative by 0.4%. It's a break of 111. It's 110.88. Eurozone headline CPI coming out a little bit earlier, dropping below 2% for the first time since 2021. So if we're having conversations about big rate cuts at the Federal Reserve, why are we still not having them at the ECB?
You have Germany falling below 2% in terms of inflation for the first time since 2021. The Euro region inflation rate, 1.8%. You have the prospect of a recession, an entrenched recession in the biggest economy in the region. And then you have Christine Lagarde saying, well, we'll check the data as it comes. You know, I mean, it's sort of people now baking in a whole host of rate cuts by the ECB by the end of the year.
A weaker euro, 110.88. Under surveillance this morning, some top stories for you. Israel beginning targeted ground raids into southern Lebanon. The Israel Defense Forces saying its forces are striking targets located in villages close to the border that pose an immediate threat to Israeli communities in northern Israel.
I think really the key word there is targeted. So I spoke with a U.S. official yesterday who basically said there was this understanding between the White House and the Israelis that the scope of this would really be towards and limited to that border. A big question based off some of these calls I'm having is what will Lebanese Hezbollah do? Will there be some sort of retaliation? And then how much longer, you know, the U.S. puts out these statements about this idea that they don't want this to expand. They want to see peace in the region. How much longer does this push diplomacy down on the timeline? I was struck by what Lloyd Austin and the Israeli defense minister put out yesterday, Gallant. They agreed on the necessity of dismantling attack infrastructure along the border. So the big question will be here whether or not it extends past that.
Yeah, just to put it another way, how much do they have to do in order to get the 70,000 people in Israel back to their homes in the north? And that ultimately still remains to be one of the big questions.
We've just seen a series of escalatory steps over the last week, and they continue. I want to turn to this story, just a quick update for you. Dock workers walking out of every major port on the U.S. East and Gulf Coast for the first time since 1977. The strike halting container cargo and auto shipments from Houston to Miami. JP Morgan estimating the economic loss from the shutdown will be between 3.8 to 4.5 billion US dollars every single day. Andrew Hornhorst of Citi with us in about 15 minutes. Look out for that. J.D. Vance and Tim Walz facing off in New York tonight for the only scheduled vice presidential debate. The candidates aiming to boost their campaign's momentum when they take the stage at 9 p.m. Eastern time with Election Day 5 weeks out.
So what's interesting about this is we're ending this election cycle potentially on a final debate, and it's not the top of the ticket. It's the vice presidential candidates. Their mics will be hot, so potentially there will be real moments, tangible moments where they have these back and forth. They've been sniping at each other for weeks. So this is going to come really to the forefront today. So I'm interested to see what kind of movement there is with the mics. And the whole point of a VP is to do no harm. So I think who does harm today will depend on who wins.
I'm just curious, what's the point of this? I'm serious. Is this to get policy, or is this
What's
basically...
the point of the debate?
Or no, in this particular debate, is it basically policy? Is it favorability? Is it like an MMA match where people want to see who gives a strikeout? I'm serious. Is it entertainment? I actually am curious because I wonder how much this is actually to determine policy beyond what we've already heard.
All right, it's going to be a lot of style, a little policy, but I think it depends on the viewer, depending on what you want to get out of it. These two men are pretty relatively unknown, especially Governor Walz. I mean, maybe they're reigning kings in the Midwest, but on the coast, they're not that well known. I think this is a chance for both of them to acclimate themselves with American society.
Stay tuned for Bloomberg coverage later on this evening at 9 p.m. Eastern Time. The U.S. Southeast grappling with the aftermath of Hurricane Helene. More than 100 people have died across 6 states, with floodwaters destroying homes, leaving millions without power and cutting people off from fresh water. Republican Senator Bill Hagerty of Tennessee joins us now for more. Senator, thank you very much, sir, for taking the time to share your thoughts with us this morning. I know your state is going through a lot right now. I don't think the rest of the country still fully understands the magnitude of the issues on the ground. Senator, you've been surveying and assessing the damage. Could you share with us what you've seen?
Well, again, thanks for the opportunity to share this with America and with the people around the world. The devastation is enormous here. Just to put it into perspective, they talk in terms of events that occur 1 in 100 years, 1 in 200, sometimes an event like this 1 in 500 years. We've seen one of those back in 2010, very concentrated around Nashville. This is one in greater than 1,000 years. We've never seen anything like this, Chris. And it was explained to me that if you look at the volume of water that came down through this rainfall, this storm, and spread it across the state of Tennessee, it would equate to a depth of 3 feet of water across the entire state. Just let that soak in for a moment. I was talking with the director of the Newport, Tennessee Utility District yesterday. He told me as the water came in, it was ankle deep, and then he started seeing it moving. He told his men to run. In 5 minutes' time, it was chest deep. That's like a tidal wave hitting. It's going to forever change the terrain in this part of the country. I was with Mayor Woodby yesterday in Clark County. She was telling me about the Black Hawk helicopters that I just saw her get off of. She disembarked a Black Hawk helicopter to come talk with me. They're running water, generators, supplies. She said she needs oxygen. They're having to use helicopters because these towns and cities are cut off. They've lost the bridge access. They've lost road access. There's no way to get there except by military helicopter. And I have to say our National Guard has stepped up tremendously. As of yesterday afternoon, there are going to be between 220, 250 guardsmen on the ground there. We've got to continue to accelerate this. We've got to get debris removal crews in here now. FEMA's got to step up, and I think they're doing everything they can, working with our local Tennessee emergency management to step up, get resources here, assess the situation immediately. repeatedly. The water's receded adequately now to see the massive extent of damage, but people are hurting very, very badly right now. As I said, we need oxygen for people that have to have this. We got to get these to people who are landlocked and cannot access roads and highways to get out of the area. Helicopters is the only mean access right now.
Senator, you alluded to it. Let's build on it. Are you getting all the help you need from the federal government?
Yeah, my job is to make certain that we do. And I spoke with the White House yesterday. I'm sure I will speak with them again today, just to continue to update them and make certain that we keep pressure on the situation. I think all eyes were pointed toward Florida in the beginning. That was the initial landfall, but the resources have been diverted there. Far more are needed up here in Tennessee right now. Same is true in North Carolina. I talked with my colleague Ted Budd yesterday. Western North Carolina hit extremely hard. And what happens is you've got whole communities that are isolated. They don't have water. The water management system here is in enormous trouble. Wastewater management. There are several systems that are completely out, meaning people are on boil alerts. They can't even get water through the pipes. And if you can imagine how water gets to some of these communities, they use bridges, not only to transport vehicles and people, but those bridges have pipes running underneath them that they're using for water supply. Those bridges are out. The water supply is gone. Electricity, a big issue. Tennessee Valley Authority, largest utility in America, the most sophisticated when it comes to water management and dam management systems. They've done a tremendous job getting people back online, but we still probably have 18,000 people that don't have access to electricity. Thankfully, it's the fall. The weather is relatively mild, but this is a serious challenge. And what we've got to do right now is manage the level of our lakes, manage the dam system so that we can get this water moving out of here, because there's another storm brewing in the Atlantic that, if it turns the wrong direction, could be here again in another week.
Senator, it's great to hear that you're getting all the help you need right now. Biden was asked, though, yesterday if Congress should return for special session. He said that is something I may have to request, but no decisions have been made. Do you think Congress needs to return to make sure places like Tennessee continue to get that aid that you so desperately need?
I would be all for that. I know that we're looking at every way to accelerate funding right now, but this is a critical situation, one that we've got to address. And if additional emergency funding needs to be put through, we should get to Congress. We can do it in a day, but we need to do everything we can. We have citizens that are literally, they're going to get worse by the day as they don't have access to water, they don't have access to electricity, and importantly, don't have access to critical medical care, as I mentioned, access to oxygen or other. You think about kidney dialysis, those sorts of things. This is going to get critical, more and more severe as we move along. The ground is also saturated. So if we do have another event, it's going to be much worse. So we really have to deal with this as rapidly as possible and resource this very, very quickly.
You talked about the power outages. A lot of the reports we're seeing is that a lot of people can't even call 911. Do you have a timeline of when potentially you're going to get power lines back up and running?
The Tennessee Valley Authority is working night and day on this. I met with many crews yesterday. I was with the TVA team a good part of the day yesterday. They're getting power up as quickly as they can. An important piece of this, though, is getting broadband back up, because our wireless system isn't working in that area. So we have a lot of people that are missing. I talked to the school principal yesterday. He's missing a number of the children in the school. That doesn't mean that they are in harm's way, but he can't communicate with them. That is creating a tremendous amount of anxiety for families here, as you can imagine. They don't know where their loved ones are. They don't know how to reach them. And it's going to make it extremely difficult to locate folks until we can get that system back up. So Tennessee Valley Authority is working night and day on this aspect, too, as are the carriers.
Have there been any discussions about Starlink? I know that was one thing that was floated.
Yes, Starlink is being implemented right now. I was with emergency responders yesterday. They were uploading Starlink, so that is being utilized right now. At this point, it's only with emergency responders. We'll continue to see how we can broaden that access, but as you note, communication is going to be very critical, and Starlink may be an important part of that.
Senator, you mentioned that the land was saturated, and if we get another event, you could see just a real escalation of a lot of the trauma that's been experienced. How do you develop the land and sort of recover from this and give people the confidence that there are new safeguards in place to really protect should there be another massive storm that comes through?
Well, as I said, this storm was so unique. The magnitude of it's something that we haven't seen in recorded history. It's a greater than 1 in 1,000 year event. At the same time, though, this has put us in a much more vulnerable situation for the next big storm that comes along. So the saturation of the ground, the fact that we already have water treatment facilities that are out, it's going to require incredible management just over the next week to make certain that we're in the best possible condition to take another hit like this. I'll just share with you a snippet, a story of what's happened here just over the past couple of days. An important bridge, a critical bridge to get to a community was tested. The bridge was okay, but a 2,000-yard segment at the approach had been washed out. The local county managers are out trying to assess what to do, and a gentleman came up and he said, you know, I've got a bulldozer. Maybe I can help. They said the next thing they knew, he brought several more pieces of equipment. He brought more friends, and in about 36 hours, they worked through the night. They had rebuilt this 2,000-yard section. That bridge is open now. That's a Tennessee volunteer for you. We are seeing outpour of help and volunteerism like we've never seen before. But we actually need resources and equipment, as I mentioned, debris removal equipment, things that the National Guard can provide that require certain expertise, getting electricity back up, getting water management up. It's going to take some time. It's going to take resources. And thank you for giving me the chance to explain this to the people of America.
No, thank you for your time, sir. I think that's a good place to finish this conversation. If people outside of the state want to help, what's the best way they can contribute to your efforts?
The Red Cross and the Salvation Army are on site right now. They have networks in place that are very good at working with this. The Tennessee Emergency Management Association on the ground here knows exactly where the critical points are. That's for people that want to actually come volunteer, help, and work. And we've got a tremendous amount of damage to work through. This is going to take not days, not weeks. It's going to take months to navigate through this, in some cases with massive infrastructure that's been damaged, even longer than that. But I'll say this, our dam system has held up remarkably well. The Tennessee River is an incredible water system. We've put it in place over decades, and it has proven to be extraordinary. I was at the operations center yesterday that the Tennessee Valley Authority uses to manage all the various water levels that they've got to do to get water moving from a higher lake to a lower lake to the next lower lake. And it's incredible what they've been able to do and accomplish. The damage would have been far worse had we not had this technology in place.
Well, you and the people of Tennessee are in our thoughts. Thanks for being with us this morning, sir. We appreciate it. Thank you. Senator Bill Hagerty there of Tennessee. A difficult moment for that state and many states across this country right now.
And we're just beginning to understand the depth of how much damage has been done and how long it's going to take to really recover.
Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahira Heckes. Hey, Yahira.
Hi, John. Bloomberg is reporting that Boeing is considering raising at least $10 billion by selling new stock. According to people familiar, the plane maker is looking to replenish cash reserves that have been further depleted due to the ongoing strike. Boeing has burned through cash following a near-catastrophic accident back in January that forced it to slow production of its 737 MAX airliner. Meanwhile, Michael Dell has unloaded more Dell stock. He sold 10 million shares of his namesake company stock worth more than $1.2 billion. This marks his second significant sale in September. Earlier, he sold 10 million shares worth more than $1.1 billion. The stock is up nearly 55% year to date as Dell benefits from investor interest in artificial intelligence companies. And baseball legend Pete Rose died at the age of 83 on Monday, according to his Cincinnati Reds spokesman. Rose had a storied career, winning 3 World Series championships, 3 batting titles, and making 17 All-Star appearances. Though Rose maintained for years that he never bet on baseball, he admitted in a 2004 autobiography that he did in fact wager on the Reds while managing the team. He continued to insist that he only bet on the Reds to win and never manipulated the outcome of any game. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Up next on the program, ports across the country grinding to a halt.
Anything that's a negative supply shock in our language that's going to raise the cost of doing business or lead to shortages, the impacts are never good.
A conversation just around the corner. The latest from Citi up next.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Max Kettner, HSBC. The most frequent question we currently get, what does it take to make you bearish? Upside risks are barely discussed, and that's why he's bullish. More on that note a little bit later. Equity futures on the S&P 500 totally unchanged, and the bond market yields a little bit lower. We're down 4 basis points on a 10-year. Let's call it 374. Under surveillance this morning, ports across the country grinding to a halt.
We've gone through in the last year or two a big strike in the auto industry. We've gone through the port collision with the bridge that affected shipping. Anything that's a negative supply shock in our language that's going to raise the cost of doing business or lead to shortages is something we're just going to have to deal with, and the impacts are never good.
Here's the latest this morning. Dog workers launching a strike across U.S. ports from Maine to Texas for the first time in nearly 50 years. Andrew Honhorse of Citi warning if the strike extends beyond a few days, shortages of certain production inputs could eventually slow production and raise prices for manufactured goods like autos. Andrew's with us around the table for a whole lot more. Andrew, in your research, and welcome to the program, you use the word escalate. Just spend some time talking about the economics of this. The longer this goes on, the chart kind of looks like this.
Yeah,
the costs just
John.
exponentially get higher.
First few days, the economy can handle, we think. There should be stocks of inventories that are there at the dock, that are there in retailers' inventories. But then as you go on, I mean, you start to worry first about things that are perishable, right? Bananas are getting a lot of attention, appropriately so, almost entirely imported. So you go a few days, those bananas that you had unloaded start to no longer be the nice fresh bananas that you like, and you run out of bananas. Now, that's one small issue, right? You can switch to apples, right? There are other things that you can consume. The bigger issue is, do you have inputs to the production process that you really can't substitute for? Are there semiconductors that are sitting on a ship offshore? Are there important other components to the auto production process? That's what we're really concerned about. Now, that would probably take days or even weeks to start to show up. So absolutely, this just escalates as it goes on.
A lot of people saying it's going to take about a month to get things back in gear once there is some sort of resolution, if it does go on for a significant period of time. How are you gaming out the economic ranges that we could see depending on how this really turns out?
Yeah, it just really opens up the distribution of outcomes, because as we go further along, and I think President Goolsbee was just talking about this, we've seen strikes before, so we look at the prior strikes, we try to get an idea of how this could affect things. We had this on the West Coast some years ago, but the West Coast imports different products than the East Coast. I mean, we remember this so well from COVID, where it's really hard to game this out until you actually know what is that individual component, what's the widget that you need in that production process that you run out of, and then to your point, how long does it take you to restock that after you've had a disruption?
We've already had a lot of questions around the economic data we've gotten in terms of its accuracy. Now you throw in the Boeing strikes, you throw in dock worker strikes, you throw in the storm. How do you back out all of the potential one-time disruptions and understand what this data is telling us at all?
Yeah, I keep thinking about the July jobs report, and I don't know if people remember, but we spent a lot of time, and Fed officials spent a lot of time talking about the effects of Hurricane Beryl and whether that had an effect on that jobs report, whether that was obscuring what was going on. The events that we've had over the last couple of weeks, the strike, there are other strikes going on. We have Hurricane Helene, of course, with a human cost as well as an economic cost. that is going to be much more significant than what we saw with barrels. So if we thought that made it difficult to interpret that July jobs report, really, this jobs report that we're going to get this week, this should be clean, but this might be the last clean one, at least for a couple months.
When it comes to the input costs that potentially this could rise when it comes to dock workers and the strike, what sectors would see that? What sectors are most inflationary?
So the first place that you'll probably see this is perishable goods, things like fruits and vegetables. Now it's not clear how much will prices rise in the very short run. Does a retailer increase the price because they're out of stock, or are they just out of stock? That's what you tend to see, is maybe not so much of an effect on the price, but this is just absorbed by retailers. To your point, it's as you start moving into that production process, it could be a few weeks from now, you can't import a car. It could be a month from now where you can't produce the new cars. And then that's where retailers will have to start to say, we actually have to raise these prices. We have a shortage of goods. We have to raise prices. But exactly like Goolsbee was saying, this is the kind of shock that you don't want to see in the economy because it raises prices and it slows growth.
Speaking of shocks, payrolls Friday, okay? Bear with me. The estimate for Friday is 150. The high over at Jefferies is 220. And then there's this guy that put in 70 for Friday. This guy's you. What's going on over at Citi? Where does 70 come from?
Yeah, I think it's not that hard to get to a 70 number. And that's what's interesting about the forecast to me. If you look, so there's an argument for 150, which is that if you look at maybe a 6-month moving average or a longer moving average, we'd be running around 150,000 payrolls. But there's an argument for 70, which is we're running in the private sector at about 90,000 jobs per month and overall about 100,000 jobs per month. And then we have some specific areas of weakness where we've seen construction activity that's really slowed down, but we still have a lot of construction workers. Now, we kind of saw this in manufacturing last month where we had a big decline in manufacturing payrolls. We'd already seen several months of weaker manufacturing data. So we think that the employment data is going to kind of catch up with some of what we're seeing in activity. But the point you're making, I think, is a good one, that there's a range of outcomes that are possible.
If I'm an investor, should I be scared of 70? Should that worry me about the trajectory of this economy?
I think it should. I think it should. I think you should already be worried by 90,000 a month private payrolls. This is really a level of job creation that we usually see only going into a downturn or at least a significant slowdown. And I thought it was really interesting, Chair Powell, yesterday, he was asked this question, the rise in the unemployment rate, is it a supply story? And he said, at this point, we really have to look more at the demand weakness side of it and the slowing in payroll growth.
That's your camp and has been for a while. Andrew Honhorst of Citi on the latest with the port strikes, what it might mean for the economy, and looking ahead to payrolls Friday. The estimate there is 150 on Friday. Andrew's looking for 70.
And meanwhile, the data is going to get only messier from here in terms of trying to interpret it. Just a public service announcement. There are more than 1,000 varieties of banana, but we only eat one of them, and it is potentially fragile, and it will potentially not be there for your breakfast.
You can have apples instead.
Yeah, but that also is threatened by the strike.
That's threatened too?
Yeah, so just be careful.
Okay, no fruit.
No fruit for you.
No fruit for you. No fruit for you. Coming up on the program, Seema Shah of Principal Asset Management, Republican Congresswoman Lisa McClain of Michigan, Bloomberg's Danny Berger as the port strikes ramp up, and Lindsay Rosner of Goldman Sachs Asset Management. The second hour of Bloomberg Surveillance, up next.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We're in the midst of a global easing cycle, but a fast-moving Fed can open the door for that to be faster.
We do have a great soft landing scenario right now.
If you were to get a reacceleration in inflation, I think the Fed goes on hold.
Our base case is one more 50 and then back to 25s, but honestly, everything's on the table for this Fed.
The impact of the eases won't be known until the middle of next year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. 5 months of gains in the equity market, 5 months of gains in the bond market, kicking off October and Q4 looking like this. Equity futures on the S&P 500 just about positive by 0.05%. On the Nasdaq, we're positive about 1/3 On the Russell, just a little bit softer. The scores for Q3, the S&P up around 5%, the Nasdaq up around 2%, the Russell up around 9%.
This has been really the story of Q3, this idea of rotation, gaining traction, yields lower, fueling this feeling that maybe we are on the cusp of a new cycle that could really lift up some of the other 493 and beyond stocks. Question now is, has this market gone too far, too fast with respect to rate cuts and just how much that can save everything?
We are data dependent, so let's talk about the data. The week ahead looks like this. Later on this morning, 10 a.m. Eastern time, you'll get ISM manufacturing and job openings as well. Look out for that. And as we work our way through the week, at least we're working towards payrolls on Friday. The estimate in our survey, about 150.
And basically, the key question here is how high or how low is the threshold for this Federal Reserve to come in with another massive rate cut? I would argue on the flip side, whether it's Mike Wilson or Peter Scheer, a real question about how hinged this market is to either an upside or downside surprise. Peter Scheer earlier this morning saying an upside surprise would actually cause just as big, if not a bigger sell-off as people recalibrate just how many rate cuts really can happen.
Reading this economic data is always nuanced, complex, difficult. It could be even messier. Lisa mentioned this in the last hour. We're talking about the first major strikes on U.S. East and Gulf Coast ports since 1977. And the longer that goes on, the messier this data gets.
And it's half of U.S. trade. This could be potentially, and if this lingers on, a tremendous amount of chaos at these ports. And to Andrew Hollenhorst's point is in the beginning, it's not the impact that you'll feel almost immediately, but then that can build up, whether it's bananas or semiconductors that go into autos. Potentially this can have an inflationary impact on the economy and the jobs. Not just this, but also the crisis that's going on in the southeastern states when it comes to the hurricane. How messy is the next payroll report going to be?
Well, Andrew Hollenhorst was talking about Hurricane Beryl and how that caused some question marks around some of the jobs reports in the summer. That was not quite as significant as any of the things that we're seeing right now, even in taken in individual. Meanwhile, we're talking about the potential. Morgan Stanley's Seth Carpenter coming out saying maybe 70,000 jobs have to be taken off the total as a result of some of what we're seeing right now. The data has been difficult to interpret. It has been difficult to understand this cycle. Just imagine how much more difficult it's going to get to really understand.
Yeah, the October jobs report could be an absolute mess, and you'll get that report just before you get the November 7th Federal Reserve meeting, which is 2 days after an election we might not know the outcome to.
That's perfectly framed. just how much of a black box is this Fed operating in? And then in turn, is this market operating to understand the Fed's reaction function and then to even understand the trajectory of the economy? And this is the reason why the bifurcation of the upside and the downside for this economy has just continued to grow despite the ongoing string of data that we're supposed to be dependent on.
We've said it repeatedly on this program, flying blind into 2025. Equity futures on the S&P 500 firmer here by almost 0.1% after the run we've seen in the bond market. 5 months of gains for treasuries. That means yields declining for 5 consecutive months. Yields are down again, kicking off October. We're down by 4 basis points to 3.74. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as we kick off Q4. Republican Congresswoman Lisa McClain on the swing state politics of Michigan. And Bloomberg's Danny Berger as thousands of port workers walk off the job. We begin this hour with U.S. stocks posting 4 consecutive quarters of gains, the longest streak since 2021. Seema Shah of Principal Asset Management writing this: the attractiveness of cash has declined. There is some $6.4 trillion currently in money market funds, potentially representing an important tailwind for risk assets. Seema joins us now for more. Seema, you sound bullish. Walk me through why and where that cash is going to go.
Sure. So yes, we are bullish. I don't want to say overly bullish. We're very cognizant of the number of risks out there, but I think what we're really basing it on is you have a global monetary stimulus cycle in play. You have a Federal Reserve, which, yes, very, very clouded, very difficult to navigate its way with all the uncertainties that you've been talking about with regards to the data. But they are very much committed to soft landing. So that's the one thing that we are hanging our hat on, is you're very unlikely to see a recession materializing over the next 18 months. So that is a good backdrop. It doesn't necessarily mean that you're going to see enormous equity gains. I actually doubt that you're going to see the same kind of pace of gains that we've already seen in the first 3 quarters of the year extending through to 2025. But you have a growth backdrop. You have a Fed monetary easing program in play. That should be positive for stocks. It should be positive for credit as well. So from our perspective, why be in cash when you know that rates are coming down and there's so many other gains to be had on risk assets?
The story you describe is precisely why we've had this massive US overweight, and it's been building over the last few years relative to the rest of the world because the relative story around the world has not been great. Seema, with that in mind, is it time to rejig some of that story, cut some of that overweight, redeploy some capital abroad, look internationally? And a question I think a lot of people are asking themselves this morning is, well, I've seen this movie a few times. This has been head fake after head fake. I know how this ends. Is it different this time?
So I don't want to use those words. I'll get told off by all my colleagues for saying that. But I do think that this is a time to be thinking about global diversification. It's not necessarily pulling away from the US. So, you know, with all that cash sitting there, you need to deploy it somewhere. It's about whatever you're going to add, try and think about where the global diversification is, because valuations around the world, in some pockets, not everywhere, but they are quite attractive. And as I said, it's not just the Fed that is easing, but you're seeing other central banks around the world moving. I think China is an interesting story. We have a lot of, I think, skepticism about how much it's going to be sustained, how significant stimulus is going to be, how it's going to be implemented. But we do think that there will be positive benefits from a risk sentiment perspective for other parts of Asia. So I think that there are places outside of the US that we can think about, but also within the US. You know, we've all become very accustomed to having that exposure to the Mag 7. We're maintaining that, but I think there is also some space for some tactical opportunities within the small cap space.
I want to understand the bullish case and what's been priced in already, especially when it comes to the relationship of stocks and bonds, stocks and the Federal Reserve. How much of the rally and your bullish sentiment really hinges on this rate cutting cycle that will pick up steam even if we don't necessarily get really negative employment data?
So I think some of it is hinged on it, but as I said, we're not expecting the gains to continue at the same kind of pace we've had. I actually think that it's quite difficult in this market with these kind of valuations, unless you were to have some kind of clean out at this point, to have another 20-25% move higher. So we're thinking more about in the single digits for returns. There is a lot of uncertainty about how much the Fed is going to cut within the next few months. Are they going to front load, or are we going to be looking at a more of extended cycle? But as I said before, the thing that we're thinking about is, look, the Fed we know is committed to that soft landing. They've started to cut rates against a backdrop of still positive growth where there is no financial crisis simmering. That is a very, very positive backdrop, which should assure a soft landing. And against that perspective, then you should have continued earnings growth and equities moving higher. But we do think that instead of just focusing on the Mag 7, it's really time to think about other parts of the US market and the global complex.
I feel a bit whipsawed, Seema, because we've been talking about all of these catastrophic situations around the world and how it could potentially affect employment, how it could affect inflation, how it could affect growth over the short and potentially longer terms, how it could disrupt supply chains. And yet markets have shrugged it off, don't seem to be pricing it in at all, which I guess makes sense because in the past it hasn't come to fruition as a tangible risk. Of the potential issues that we see on the fore, whether it's the storm, whether it's the strike, we're talking about the US, whether it's what's going on in the Middle East, what do you have your eye on potentially as the most disruptive event?
I actually think that the disruptive event is of course this is from a market perspective, the most disruptive event is really what it does to the data. We know that this is a Fed which is very data dependent. This is a market which is also very data dependent. So as much as the data becomes more and more muddied, I think that you're going to see a lot of whips, or we've already seen volatility pick up, that there's a risk that continues or even exacerbates over the coming months. And of course, there's always a chance that you take the wrong turn because you're so clouded and blinded.
When it comes to China, I know you mentioned that earlier, but you talked about that this week was a pivotal moment for it. It all comes down to the details. So far, do you like the details that are coming out of Beijing?
Yeah, we do. We are quite encouraged by what we're hearing. We really need to see clear numbers. We need to see a little more information about the consumption drive. Are we seeing kind of direct injections to consumers, or is it done through subsidies? So there are different ways which are going to make it a little bit more impactful or less so. But overall, I think the positive thing that we're hearing from the government is that they recognize that something needs to be done, and it needs to be done in conjunction with monetary stimulus. It's not enough just the monetary policy cuts. There has to be some kind of spending coming in play. I think that is positive. It should have a good impact on risk sentiment in terms of how much further we think about China GDP growth going. Does it hit the 5% level or not? That really comes down to those specific details. But at least for this point in time, we're hearing all the right things from the government, and that should have some positive externalities outside from China as well.
Can we talk about the limits of that positive fallout? Let's talk about that right now. Peter Chi of Economy was on the program about an hour ago, and he made the point that the story out of China is a story for China. Chinese brands, Chinese companies. And the spillover, the positive spillover, is limited to the rest of the world, particularly to European companies. Seema, what do you make of that argument?
I wouldn't necessarily agree. You know, when we've done the charting, there's actually a pretty clear correlation. You have China credit stimulus, or whatever kind of stimulus measure that you want to use. There is a clear impact on the US ISM manufacturing survey, for example. So we do think that there is a positive impact. And in fact, for European companies, you could actually see some of the luxury companies benefiting. So China's consumption has been limited within China up to now. We could see that streaming out to other parts, particularly in Europe. Now, I don't exaggerate this because we're actually quite negative on Europe as a whole. But in terms of what the impact could be outside of China, I don't think it's huge, but I think it certainly could be quite positive, particularly at a time for the rest of the world when expectations have been quite low outside of the US.
Rock bottom over the last few years. Seema, thank you. As always, Seema Shah there of Principal Asset Management. Equities just inflecting just a little bit higher, turning positive. We're up by 0.1% on the S&P 500 with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. BlackRock CEO Larry Fink thinks the market is pricing in too many Fed rate cuts. In an interview with Bloomberg's Francine Lacqua, Fink said it's tough for him to see another 50 basis point cut given growth in the U.S. economy.
I see more policies by more government that tend to be more inflationary than deflationary. And so with that in mind, it's hard for me to see another 200 basis points of decline in short rates.
Fink went on to say he believes there's more room for easing, but not as much as the forward curve would indicate. Meanwhile, Abu Dhabi National Oil Company has agreed to buy German chemical company Covestro for about 12 billion euros, and what's lining up to be the biggest Middle Eastern